Welcome to this beginner bootcamp, the ultimate guide for anyone who wants to kickstart their trading journey. I'm DionTrades, and in this video, I'm going to show you exactly how to transform your trading from zero to hero in 2.5 hours. I will guide you through 3 simple steps. First step is building your foundation. We're going to cover candlesticks, time frames, and deciding what to trade. Then we're going to set up your tools, TradingView, look at market structure, and how to trade indices. After that, we're going to master your executions and your management. We'll explore leveraging your trades, choosing brokers and prop firms, and understanding what type of trader you actually are. These are the exact steps I followed to transform from a beginner into a consistently profitable trader. I designed this bootcamp with the mindset of, this is what I wish I had when I was starting out. By focusing on these 9 key areas, I was able to overcome challenges and build a strong, sustainable strategy. Now I'm sharing this exact roadmap with you so you can achieve the exact same success. So without further ado, let's start with candlesticks. Alright, welcome to episode 1 of the Beginner Bootcamp. We're going to talk about candlesticks. Please don't use this as a Netflix. Take out your notepads, take notes. If there's any questions, let me know in the comment section below. And if you like these kind of videos, please like and subscribe. Without further ado, let's dive in.
When you start trading, one of the first things you see on a trader screen, in general, it looks something like this. You see a window with lots of lines, colors, and just a whole bunch of stuff you don't understand yet. Today, with candlesticks, we're going to talk about the figures right here. You see up, down, and all these single parts are called candlesticks. A red candlestick, a green candlestick, a red candlestick is down, a green candlestick is up, and every single second, every single hour, every single day, a new candlestick is printed on the chart. So in this episode, first we're going to discuss how to read candlesticks. Then we're going over how to trade them. We're going to the charts to see some actual examples and give you some rules. And then we're going over some basic patterns and some more intermediate level patterns to further develop your understanding. And at the end, I will give you a nice entry model so you can already start seeing some trades on the chart yourself. How to read candlesticks. In this first example, we're looking at a bullish candlestick. A bullish candlestick is most of the time a green one, so an up candle. And there are a few things you should know about the candle. First of all, this green box is called the body of the candle. These small lines up and down are called wicks of the candle. In an up-close candle, price will open here. So this is the starting price of this candle. Then price will go lower, creating the wick. Then it goes upwards price, creating the body of the candle. And then when price here, it goes a little bit down, creating the closing price. So here, it's open. Then we create the low of this candle right here. Then we're going all the way up, bring the high of the candle, then we close. So the candle looks like this, but on the chart in a line, it looks like open, low, high, close. The body, wicks, open, low, high, close. This is the only thing you should remember about how a candlestick looks like. Same for a bearish candle, a down candle. Most of the time, those are red on the charts. You can give them different colors, but by default, green is up, red is down. A bearish candle starts here, open, then it trades higher, trade the high of the candle. So the body starts here, then the wick, high of the candle, then it trades all the way down, saying the low of the candle, and then we have to close. The difference between a bullish candle, a green one, and a bearish candle, a down one, is that the open of a bearish candle is up here, and the open of a bullish candle is down here. Open, low, high, close. And a bearish candle is open, high, low, close. It's the other way around. Now let's go a little deeper into this. You just saw a nice balanced candle right here. Body, the wicks are kind of the same length. But what if you see this on the chart? So remember, this is the open. Then we go all the way down here, saying the low of the candle. Then we trade all the way up here, saying the high of the candle, and then the close. What does this say about what price is doing? In this example, we have lots of buy pressure. Why? Price starts here. It goes all the way down here, saying the low of the candle. But then, in the same candle, it trades all the way back up here and then closing right here. That means we had some sell-off here, going lower, but this candle shows lots of buying pressure because of this candle. Open, low, high, close, lots of buy pressure. And it means if you see this candle, you can predict that most likely the next candle is going to be a green one. Because we had so much buy pressure, you can expect the next candle to be green as well, to go higher. There's a name for this candle, and it's called a bullish hammer. There's no need to remember names of candles. You just need to understand if a candle looks like this, then on the chart, the price action is like this. So open, low, high, close. Lots of buy pressure. And vice versa for a bearish candle. So you know, with a bearish candle, the open is here. With the opening price, we go all the way up. At the same candle, we go all the way back down. Creating the low of the candle here. So here, lots of sell pressure. So that means the next candle is most likely going to be a red one. Lower prices are ahead. And this is called a bearish hammer. So now you know what a normal candlestick looks like, a bearish and a bullish one. You know how a hammer looks like with lots of buy and sell pressure. But what if a candle doesn't have a wick or a really small one? What does that say about a candle? If you have a green candle with no wick, so that means price opened here and without going lower, it just went straight up. That means we are very bullish. The same for a red candle with no wick. We opened here and we didn't go higher. We just go boom, straight down. So that means a candle without a wick, if it's the green one, it's very bullish. If it's the red one, it's very bearish. So with the green one, there's lots of buy pressure, pushing price higher. If you see this on a red candle with no wick, there's lots of sell pressure. That's a very bearish sign. Let's continue with what we just learned. Here you see a red candle, so price is going down. Then we reach an important level. And an important level, for example, can be an old monthly low. So for example, it's now July, and we reach the lowest point of the month of June. If you see on an important level, the price trades lower, lower, lower. When reaching this point, what does this candle do? Open, low, high, close. Because we reached this important level, but what we did is we didn't go lower. We reached the important level, but there's no body here. There's a name for this. We're going over that in a second. But if you see this happening on an important level, you can expect the next candle to be green. You need to follow the momentum. If this red candle was followed by another big red candle at this important level, you can expect the trend to just go down, down, and down. But what we did, we reached the important level, and then we saw higher prices. This was no red candle going lower. This was a green candle. It's indicating a reversal. Then you can expect the next candle to be green. So very important, follow the momentum. Same on the other side. So for example, you reach a important level, a old high. So price here, open, low, high, close. So in this candle, we are going towards the important level. And then this candle, we open here. The high of the candle and the low of the candle, and we close here. What does this say about price? Follow the momentum. We are at an important level. We don't close over this because the close of the candle is down here. It's also indicating a reversal towards lower prices. Open, high, low, close. Every time you see a candlestick, try to figure out how the line is moving there. But to repeat here, open of the candle. Here, we're going lower, then going to the high of the candle, the high of this wick, and then we close here. It's the framework of a bullish candle. Then the framework of a bearish candle is the open is not at the bottom of the candle, but at the top of the candle. So here, right here, open, high, reaching an important level. We are reacting from this level, take the low of the candle, and then we close here in this candle. The next candle opens here, open, high, it's wick, goes all the way down, low, low of the candle right here, and then it closes right here. And again, follow the momentum. So here, we reach an important level. We fail to close under it. The close of the candle is right here. So then you can expect higher prices. Vice versa, reach an important level. We fail to close above it. And then you can expect lower prices. A little extra to this framework is compare the size of the candle with the wick. The bigger the body compared to the wick, there are more momentum and volume in the candle. So let's draw this out again. We open here. High, low, close. And we open this candle. Open, low, high, close. Open here. Open, low, high. You see the momentum in this candle. Ooh, higher prices. And on a line, it's maybe very easy to see. But you need to learn how candlesticks look like. How candlesticks show exactly the same as a line chart. So the bigger the body compared to the wick, the more momentum is in price. If you see this happening on your chart, we have a red candle going down. Probably here, important level, somewhere here. You see price reacting and then having a big volume higher, well, my money would be on that the next candle is going to be higher again. And how would that look like? We have an open, we have a low of the candle, we have the high of the candle, and then we close. So this is of course, this color is red, but it needs to be a green candle. Green. In the second part, we're going to talk about how to trade candlesticks. And I'll give you 4 rules as the start of the framework. And the first rule is look at candlestick patterns at important levels. And now let's dive into TradingView. That's the tool I use where I trade in to see an example of this. So right now we are at TradingView and you see here the rule, look at candlestick patterns at important levels. For example, old highs and lows. If you zoom out here, I marked a line right here at this old low. There's also an old low here. And I want your eyes to be drawn to this. What do you see here? So price is going lower. See this very bearish candlestick? Lots of volume lower. Open. Low. And then here the open. Going lower again. Then we're going higher again. Price here comes to an important level, but the body is not closing below here. You see that we at an open, high, low, but the close is all the way up here. This could indicate a reversal. And you see how the candles next to that indicate we were higher prices. So we reached an important level. And then after that, we went to see higher prices. So very important there is do not look random in the chart. Look at the important levels. So for example, if you would have looked for the same pattern right here. Yes, you saw like down close candles and then the massive wick down and then the body's closing up here. That indicates with a hammer that we're probably going to go higher. But you would think there, okay, this is a reversal pattern. So, okay, I see this and then we'll go higher towards these highs, probably. But the thing is, this low was not made at an important level because there was no low here. There was no important level. There was nothing for price to do. An important level is an old low, for example, right here. That's why do not look random in the charts. Look at these kind of patterns at important levels, like here, when we touch that low. Same here. We have an old high. And you see price goes into it. So open, high, low, close. And we fail, the body fails to close above this high. So probably we'll see lower prices. And look how at an important level, this indicates the start of a big move downwards. All the way down here. And in the same example, if you, for example, would have looked for this exact same pattern right here, yes, you swept an old high, but there was not a significant high because it was in the middle of this whole range, this whole price action. This is a significant high because it's all the way up here. It's the top of the range. And then you saw this pattern. So you knew, okay, I see a green candle, but then we failed to close above it. So open, high, low, close. So we're going lower. If you are looking for this at a random place in the chart, then you probably thought, okay, we'll go lower towards the lows here. We didn't because this pattern wasn't there at an important level, not an old high or low. Later in this bootcamp, I will go over more important levels. For now, we're only sticking with old highs and the previous example with old lows. The second rule is look if price respects a key level. And how it looks like on the charts. Look at this high. This is quite a significant high with big move down after that high. And let's see what we do. And the rule is look if price respects a key level. If we see a reversal from this high to the downside, it's respecting the key level. If it breaks it and goes higher, it disrespects the level. Well, you can see, of course, in hindsight that this key level is not respected. Price goes through the old high, disrespecting the high. And if you see that key level being disrespected, then your eyes should immediately go to where is the next important level. That was here. So you could have taken a nice long towards this high from this point where you knew, okay, we're not going to respect this level. So in this candle, you could have made your money. The third rule is the lower the time frame, the less reliable the price action. We will go over what time frames are exactly in a later video in this bootcamp. But for now, we are looking at the 5-minute time frame. That means that every candle is 5 minutes of price action. And the rule is the lower the time frame, the less reliable the price action. And a nice tip here, if you are in doubt, zoom out. And with zoom out, I mean you can go from the 5 minutes, for example, to the 1 hour time frame. At the 1 hour time frame, every candle is 1 hour. So if you look, for example, at this piece of price action right here, this is not very nice. Like it goes up, down, it doesn't go anywhere. And if you're looking for important levels and maybe some patterns, on the lower time frame, it is just simply less reliable than on the higher time frame. If we look at this exact piece of price action on the 1 hour, it's more clear because the 5-minute time frame here, it just looks like sideways movement. But if you see here, we reach an important level that's right here. Why this is an important level, we will go over in a later episode. And then we go lower from there. And it's already indicating a reversal. Why? You see that we, in this candle, opening, high, low, close. After that, we go higher, indicating possible bullish momentum. As we open down here, lower, higher, close. So we're probably going higher. But we failed to do it. We failed to close above this high. Here you see, open, high, low, close, lower and lower. So on the 1 hour, you could already see that the bullish momentum, which it had in this candle at 9 a.m., didn't have so much strength because the next candle didn't continue that bullish momentum. It started a bearish momentum to the downside. So when you're in doubt, zoom out. This exact same piece price action here on a 1 hour and also on a 4 hour and a daily, you can create a more solid analysis and it's going to be more clear to you. So if you compare this 5-minute price action to this 1 hour price action, simply going to the higher time frame, so zooming out, will lead to you having a more clear bias and a more clear picture of what the market is most likely going to do. And that exact knowledge you can use in executing your trades and make money. Rule number 4 is combine candlestick patterns with other forms of technical analysis. And what you think of with this 4th rule is candlestick patterns alone are not going to do it for you. Candlestick patterns are a way to read price, but you need more for that. You need a language to speak to the market. And there are so many different languages you can speak to the market. You can use indicators, you can use support and resistance, you can use supply and demand, you can use ICT or smart money concepts. And there are so many more languages you can speak to the charts. And if you combine those different languages with your knowledge of reading candlesticks, it's going to be amazing because these languages you speak with the market, those will give those key levels to you where you should expect your candlestick patterns to form. So the rule you should remember here is that a candlestick pattern together with one of the languages you can speak to the market equals profits. What you see beginner traders do very often is they start with candlesticks because that's the most important part where you need to start. And then they search online for candlestick patterns and they see these kind of books and articles with like 50 different candlestick patterns. And what they do, they're going to memorize them all, just like in high school. Stop doing that. Just don't. You don't need to memorize every single candlestick pattern. It's not a test you need to make. Find a few you're resonating with, and I will show you a few in a second. That together with that language you speak to the market, like support and resistance, like supply and demand, like smart money concepts or ICT, to take your entry setups. So with the rules and you not memorizing candlesticks, there's one additional thing you should do is trade with the trend. The trend is your friend. So if you see price going up, going up, going up, you should long the market. Why? The order flow, the trend is going bullish, is up. Why would you take a short, so lower, anticipating lower prices, if price clearly says to you, we want to go higher? Just try to wait for a little pullback to go long again. Same in the downtrend. The trend is your friend, so if you're on a downtrend, make sure you're not going too long. Just wait for price to come back and then boom, take that short to the downside. Trading against the trend is automatically lower probability. And for you to make money, how nice is it to just trade the most highest probability trades? That means that when you execute a trade, it's the most high probability that the chance is very high that the trade you're going to take is going to result in profit instead of a loss. In this 3rd part, we're going to talk about the best patterns to use, and we're going to look at some basic patterns. But first, one recommendation, get a copy of this book. This is called the Candlestick Trading Bible. And in this book, you will go over every single candlestick pattern and why you should use every single one of them. In this book, you can look at reversal patterns, continuation patterns, you can see some entry setups, but it will give you that amazing understanding of candlesticks in general. This beginner bootcamp will give you everything you need to understand candlestick patterns and trading in general. But if you want to go even deeper into this, to the nitty-gritty details of candlesticks and every pattern, I would definitely take a look at this book. And you can get it for a few bucks online. The first candlestick pattern we're going to discuss is called the morning and evening star. The morning star is a bullish reversal pattern, and the evening star is a bearish reversal pattern. When we went into the charts earlier in this video, we were looking at a morning and evening star. Remember, with that important level, we traded into it, and then the body fails to close below that important level, and then we traded higher. That were examples of morning and evening stars. Again, don't memorize the names. It's not needed. The evening and morning star candlestick patterns occur at the end of the upward and downward trends respectively and tend to indicate reversal patterns. So again, look at this pattern at an important level, old high of low, or another important level based on the language you are speaking to the market. The next one is engulfing candles, a bullish and a bearish engulfing. Also a reversal pattern. A bullish or bearish engulfing candlestick pattern may indicate a reversal. A bullish engulfing candlestick, for example, shows bulls, buyers, outweighs bears, so sellers. So this is a two candlestick pattern. In this bullish example, you see a down close candle, open, high, low, close, down close candle, but the next candle takes the low here of the previous candle and the body close all the way above the last candle's high. If the high and the low of the previous candle, and this is a down close candle, so you're expecting price to go lower, 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 but it doesn't. It goes boom, all the way up. It takes the low of the previous candle, then displaces, gives energy upwards. Same for a bearish engulfing candle. This is the high of the previous candle, this is the low of the previous candle. And if you see this candle, there's not much volume, not much momentum. It's a small candle, small body. And what price here does is open, low, high, close. And the next candle is going up and big momentum lower. So if you see a red candle followed by a massive green candle at an important level, anticipate a bullish engulfing candle, and vice versa at an important level. If you see a small green candle followed by a massive red candle, and with massive I mean a big body, big momentum, big volume, expect lower prices. The third pattern I want to discuss is a doji candle, and that's an indecision candle. So what price did here? Opened, went lower, then it went higher, and it closed at exactly the same or close to the same level as it opened. Bulls and bears, so buyers and sellers, are indecisive, so there is a little balance between them. The doji candlestick is associated with indecision in the market of the underlying asset. This could mean a potential reversal of the current trend or a consolidation. So if you are in an uptrend, for example, and then there's a doji right here, this could mean a potential reversal. Reversal means lower, or a consolidation. And consolidation is, we're going to talk about it in depth in a later episode, but you have uptrend, you have downtrend, and the consolidation is when price does nothing. It just does up and down. So it can indicate a reversal, or it can indicate with an uptrend that we just have a consolidation and do nothing. Now let's talk about more intermediate level patterns. And the first one is a harami. You can have a bullish and a bearish harami. I was looking this up. Fun fact: this is called pregnant woman. You don't need to remember that. Just a fun fact. For example, for a bullish harami to appear, a smaller body on the subsequent doji will close higher within the body of the previous candle, signaling a great likelihood that the reversal will occur. So here you see a doji candle, and the body of this candle is closing higher in this candle's body, signaling this to be a possible reversal. And how you can see this in a line chart is we have this open, high, low, close. Then we go here. So this all indicates lower price, right? We're going lower, lower. But then this next candle, open, low, high, close. Where are the lower prices? We're going higher now. So this would indicate higher prices. Same here with a bearish harami. So you're in an uptrend. And then you see this and like, oh, perhaps we might see lower prices. That's the thing about a reversal pattern. We have an open, low, high, close. Then we're going open, low, high, close. So we're in an uptrend, higher highs, higher lows. But then next candle, open, high, low, close. You see? in a line chart, we are in a nice upwards momentum, but this candle gave it down momentum. So you could, based on this line, you could of course see we're probably going lower, but this candlestick shows the same. This is called an harami. Now let's talk about inside bars, and this is a continuation pattern. Inside bars are traded within the direction of the trend. If the market is in a downtrend, the trader would look to continue with a short position, so going lower, with the presence of an inside bar. Of course, vice versa for an uptrend. So that means you are in a bearish momentum in this example. So open, high, low, close. This candle opens, open, low, high, close. We are going higher, but this is a continuation pattern lower. Why are we going lower with this? Because the candle is inside the previous candle. And because of that, you can anticipate the next candle to be red again. We're in a downtrend, we see an inside bar, and then you can expect the next candle to be red again. And the last pattern I want to discuss is the shooting star. And this is also a reversal pattern. A shooting star comes after an uptrend. So going up right here, but then it potentially indicates a trend reversal to the downside. The distance between the high and opening price of the candle must be more than twice as large as the shooting star's body. The distance between the lowest price for the day, you can say not the day, but for example, the candle itself. You have a daily candle, weekly candle, and the closing price must be very small or non-existent. That means we have this up move, but then it goes all the way down here. Big aggressive buys, aggressive sells, indicating lower prices. And of course, this also looks like that bearish hammer, what we discussed before. If you see that at an important level, you can of course indicate lower prices to come. First of all, I want to congratulate you to coming this far into the video. Most people have an attention span of less than 10 minutes, so very well done. I hope you've taken amazing notes already, and very excited to share this with you. You have learned about candlesticks in this video. You are probably at the start of your trading career, or you just want to learn more about candlesticks themselves, but you want the time between you learning about candlesticks and you actually making a trade to be as short as possible, because you actually learn the most from just taking trades and making mistakes and learning from those mistakes. So I want already in this first episode, I want to give you an entry model, and this entry model has 4 rules. The first rule is that you go on the daily time frame. So that means every candle is 1 day. Then wait for one of the reversal patterns at one of those highs or lows on the daily time frame. Can be a morning evening star, can be a shooting star. And in the bullish example, which I'm going to show to you in a second, take your entry when the next up close candle closes above the last down close candle. And then your stop loss is going to be below the low, and the target is going to be a 1 to 2 or a 1 to 3. And maybe this doesn't mean much to you yet, and that's fine, because later in the episode we're going to talk about this in detail. So here you have the rules. Here you see we are in a downtrend, and here is an important low, a daily low. So mark out highs and lows. Well, I marked out the low here. Wait for one of the reversal patterns. And what do you see down here? Down close candle, but then look at this wick. This is a bullish hammer. And then the next candle is green. So, done. Done. Take an entry when the next up close candle closes above the last down close candle. Which is the last down close candle? I would say that is this one, this red candle. Take an entry when the next up close candle closes above the last down close candle. Which candle closes above this one? I would say you can choose this one. So you can take an entry from here, or you do the next candle. It was already a big up candle. So for this example, I took an entry right here. If you're not familiar with what you're looking at here with the colors, if you take an entry in your trade, you take it at a certain point in price, and in a long move, so you're anticipating price to go up, here's your stop loss. So when you go lower here, here's where the trade is going to take you out. So for example, you take a trade with $100 risk. When price comes down here, you will lose $100. You take the entry here, entry. With a 1 to 2, that means your risk is 1. Your reward is twice, with a 1 to 2, twice your risk. So this area, this blue area is twice as big as this gray area. So you're aiming for a 1 to 2. So that means if price comes up here, we call that TP, take profit. You earn 100 risk, 1 risk, 2 reward, 1 to 2. That means big profit is $200. So stop loss below the low. We have that here, below the last low. Target 1 to 2 or 1 to 3. In this example, we have a 1 to 2. So TP is here. and we reached that up here. So we had a little drawdown. Drawdown means when price comes back below your entry, you are in a loss. From this point, you are in profit, and you can use this entry model. So the only thing you currently know is how candlestick works, but you can already take in this trade based on your current knowledge. So again, mark out all highs and lows. We did that here. Wait for one of the reversal patterns. Well, we saw that one of the stars with a bullish hammer. Yes. Take an entry when the next up close candle closed above the last down close candle. This is the last down close candle. You can take an entry here. I took it here a little late, but still good. At this green candle, up close candle, stop loss below the last low, target 1 to 2, and you have your $200 profit. If you take in a 10,000 risk, then of course you can make $20,000. But of course that's for most beginner traders, not the numbers you want to trade yet. But I hope you get my point. If you like this beginner bootcamp where you learn every single puzzle piece that you need to become a trader, then you're definitely going to like the 2024 mentorship. Inside the school group under Classroom, you can find the free 2024 mentorship right here. And in this 2024 mentorship, there are 40 plus videos that help you further develop your understanding about trading. And next to the 40 videos, there are community posts about COT reports, psychology, there are bonus episodes, there are entry models for you, so everything you need to become a better trader. When you have completed the beginner bootcamp and also the 2024 mentorship, you are at an amazing level to start leveling up like crazy. Then the inner circle mentorship comes in. This will be a private mentorship where me and my team are going to make you a beast of a trader. We're going to focus on how you level up in life, going over your psychology, discipline, your consistency. We're going over your trading plan. We're going over journaling, trade management, over getting funded, getting payouts, and everything you need to become a professional and profitable trader. You can enroll for the mentorship in the link in the description. Let's get back to the video.
Welcome to episode 2 of the Beginner Bootcamp. And we're going to talk about time frames.
In this episode, we're going to discuss 3 things. First, we're going over what time frames are. We're going to set some definitions so we know exactly what we're talking about. And then after that, we're going to apply them in section 2, how to use time frames. And after we know what time frames are and how to use them, we'll dive into the charts to see some live chart examples. First, what are time frames? My own definition for a time frame is the time for a new candlestick to be printed. For example, if you are at the 15-minute time frame, every single candle you see on the chart is 15 minutes of price action. The textbook definition is as follows. A time frame is the duration for which the trend might last in a particular asset, which a trader can identify and use to make money. You can use both definitions. I think the most important thing you need to know about time frames is this little sentence, the time for a new candle to be printed. So you know, okay, if I'm at the 1 hour time frame, every single candle is 1 hour of price action. So I need to wait 1 full hour for a new candlestick to be printed. Same with the daily time frame. Every single candle is 1 day. So the Monday is 1 day, Tuesday is 1 day. So the Monday is 1 candle, Tuesday is 1 candle, Wednesday is 1 candle, and so forth. Also the 1 minute, every single minute is 1 candle. So if you're at a 1 minute candle, in a short period of time, you will see lots of new candles being printed because you only need to wait 1 minute for a new candle to be printed. Some important notes here. Different time frames only change the information they provide to the trader. If you go to all the different time frames, you will see different stuff on your chart. But the price action is exactly the same. The price doesn't change when you look at the time frame. If, for example, euro dollar is going up, that is going up doesn't change on which time frame you look at. The price will go up. They do not change the underlying macro and micro factors that impact the movement of the markets, and they merely act as mediums to present the same information in different ways with the change in the time period. Keep in mind, time frame. So remember, a time frame is the time for a new candle to be printed. On which time frame you are doesn't change that the price is going up or down, and also doesn't affect the way price moves. It just provides you with a clear picture of what price does at a certain time frame. As you can see on the right side, you have so many different time frames on how you can see the candles print. You have the 1 second, you have the 1 minute, 2 hours, 3 months. If we have so many different time frames, maybe the first question you ask yourself is, okay, which time frame should I use? So let's categorize this already, so we have some baseline to use in our application. You can divide the time frames in 3 different buckets: the long-term time frame, intermediate term time frame, and the short term time frame. The long term time frame is the daily time frame, the weekly, and the monthly. But the monthly time frame, every candle is 1 full month. The intermediate term is the 1 hour, and the 4 hour, and the short term is the 1 minute, 5 minutes, and the 50 minutes. Maybe if you remember from this slide, you have more time frames here than on this little schematic, but I want you to filter already. This is what I use to make money, these time frames, and using these 3 buckets is going to help you a lot navigating the time frames when you're actually executing on your trading. So instead of you having like 20 plus time frames, you now have 3 buckets. Within every bucket, 2 or 3 time frames. So you can play with this. How you can play with this, we're going to talk about in a second. And how you can use these time frames, we're going to talk about right now. One important rule, which you also heard in the previous episode about candlesticks, the lower the time frame, the less reliable the price action. And what does that mean? If you, for example, compare a 1 minute candle where the price action of a candle is just 1 minute and the monthly candle where a candle is printed in one single month, because in that monthly candle, there's so much volume, time, and structure inside a monthly candle, that price action is way more reliable than only the 1 minute. And this is an important rule because the lower the time frame, for example, the 1 minute, in a 1 minute candle, there isn't much happening. It's just 60 seconds of price action. But if you have a monthly candle, a higher time frame candle, in that candle, you had all the news reports in that full month. You had all the macroeconomic stuff, like maybe rate cuts or maybe some war or political stuff going on. So the monthly candle, how it prints, tells you way more about price, basically simply by the fact that in that monthly candle, more has happened. So keep it in mind, the lower the time frame, the less reliable the price action. With the 3 buckets you saw here, we're going to apply this with the rule of 3. For a high quality analysis, you need to base your analysis at least at 3 time frames. And that means you need to have your analysis based on 1 out of every single bucket. So 1 on the higher time frame, 1 from the intermediate term time frame, and 1 from the lower time frame. You can mix and match. So for example, you can do daily time frame, 1 hour time frame, 5 minute time frame, or weekly, 4 hour, 50 minutes. And how you should use this is you want to trade with the trend. Remember, the trend is your friend. So if you see on the daily that price is trending upwards and you go to the 1 hour and you see that price also is trending upwards, that means higher lows, higher highs. Also on the lower time frame, the 5 minute, you see the same happening. We're going up. It is a high quality analysis for you to look for long positions. So you anticipate price to go higher. Vice versa. If your, for example, your weekly is bearish, it wants to go down, you go to the 4 hour, 50 minutes also going down, then your high quality analysis will be looking for shorts, anticipating price to go lower. And a very important note here, what if the rule of 3 doesn't apply? So the weekly is going up, the 4 hours going down, and the 5 minutes going up again. If the 3 buckets don't align, your trade will automatically be lower probability. Doesn't mean you cannot make money. You want most of your trades to be as high probability as possible, and that is using the rule of 3 and trading with the trend. And while you are working through the beginner bootcamp, it's also very important to already look at what type of trader you want to become. There are mainly 4 types of traders: scalpers, day traders, swing traders, and position traders. With every single trader profile, different time frames can be used. So for example, a scalper is someone who is on the charts like in and out, like a little thief, like a few minutes in, a few minutes out, and isn't spending lots of time in the market. Day traders are little more in the market. They trade from the hourly to 4 hour mostly, and they check price every like hour or so. Swing traders are the more like higher time frame people, hourly, daily. They check price every once in a like 2 times a day. And the position traders are like the hedge funds, the big money. They trade on a daily and weekly time frame, and then just look every day like, hey, has something happened to my position? And they're in for weeks at a time. I know most of you guys that watch this beginner bootcamp are or scalpers or day traders. So the framework from the 3 buckets and the rule of 3 is mainly applying to the scalpers and day traders. Because if you're a swing trader or position trader, you don't need to go to the 15 minutes. You don't need to go to the 5 minutes. You can just stick on the hourly, daily, weekly to base your analysis around and take your entries. Look at this chart and see which one resonates the most with your situation. Do you have lots of time in a day? You can train yourself to become a scalper or a day trader. If you're working a 9 to 5 or you have lots of responsibilities outside of trading, train yourself to be a swing trader or a position trader. There is no right or wrong in this. I know traders who are very successful as scalpers and day traders, but also people who make amazing money with swing trading and position trading. It just needs to fit your own situation. And now let's dive into the chart to see these 3 buckets together with the rule of 3 in action. Currently, you're looking at EuroCAD at the daily chart. And in this example, we're going to look at the higher time frame buckets, the daily, intermediate term time frame, the 1 hour, and the short term time frame, the 5 minutes. So here at the daily, which important levels do we have? The most recent important level that has been hit is this low right here. And what you see after we take that low, you see a bullish engulfing candle. The red candle followed with a massive green candle. So the energy is going upwards. This means price indicates to you that price wants to go higher. Instead of making lower highs, lower lows in a downtrend, we want to go look for higher highs and higher lows. We want price to go upwards. Price is showing its hand to us right here after we take that important level, that low, that we probably want to see higher price coming up. And here comes the importance of looking at different time frames. Because here it's daily with this bullish engulfing candle, so the energy upwards, you can anticipate if you have some entry models later down the line, you can find a nice entry somewhere around this price action. Stop loss below the low, and then target 1 to 2 towards this high right here. But what if you're also going to look at the 1 hour? Can you refine your entry? When you're new to trading, you mostly hear the term sniper entry. And what sniper entries basically are is an analysis based on the higher time frame, then going to the intermediate term time frame, and then executing on the lower time frame, but all based on that the daily and 1 hour are exactly aligned, so in line with your 5 minutes, so lower time frame execution. So now let's go to the 1 hour to see if we can find a better entry. So now we're looking at exact the same price action, but not on the daily time frame, but on the 60-minute time frame, so the 1 hour time frame, the intermediate time frame bucket are we looking at right now. So this is the same low, so we took it, big energy lower, and what do you see down here? The same bullish engulfing candle. So we take a low and then energy upwards. So if you see this, and then you see higher lows, higher highs being printed, you can already find an entry somewhere in this price action. Stop below the low. And if you want to target the same high as on the daily time frame, you won't have a 1 to 2, but you will have a 1 to 7, almost 1 to 8. And now let's look at the 5-minute time frame to see if we can find an even better entry. Now we are at the same price action, but then on the 5-minute time frame. So the short-term level. On the right side, this was our 1 hour entry. And here was the low we took out. So big movement lower. Every single candle you see, remember, every single candle on the 5-minute time frame. This is 5 minutes, this is 5 minutes, this is 5 minutes. And what do you see down here? On this, even on a lower time frame, we do exactly the same on the daily. We take a low and then big movement upwards. If you see this, you know, okay, higher highs, higher lows. You can already find an entry somewhere here in this price action. Stop below the low. And again, if you want to target exactly the same as the other two trades on the 1 hour and the daily, you will have a 1 to 18. So what you need to remember from this, the 3 trades on the daily at 1 to 2, on the 1 hour at 1 to 8, and on the 5 minute at 1 to 18 are all based on exactly the same price action. We saw on the daily, we saw that low being swept and then energetic move higher. But if you go lower on the time frames, 1 hour and 5 minutes, in that piece of price action on the daily, you zoomed in to that price action on the 5 minutes and you found an amazing entry which was aligning with the same price action on the 1 hour and on the daily. A high quality analysis is where all the 3 different buckets, higher time frame, intermediate time frame, and lower time frame align, and they all did, because after we took this daily low, we wanted to go higher, so we're looking for longs, anticipating price to go higher. All the 3 buckets aligned, and on the 5 minutes, you found the best entry. Now let's play that exact same game with 3 different time frames. So the higher time frame, the weekly, the intermediate term time frame, the 4 hour, and the short term, lower time frame, the 50 minutes. So here on the weekly, we took an important level, a high. And you see after that, we took that high here, we had massive energy downwards. And if you were looking from this at the weekly, you were like, oh, it would be so nice if I could have entered in this candle. But you couldn't on a weekly. There was no entry model. It was just one straight move downwards. But let's go to the lower time frames, to the intermediate term and the short term, to see if we can find a nice entry inside this piece of price action. So if you wanted to go lower from here, your entry will be somewhere here, towards these lows here, a 1 to 0.8. This is not a nice risk to reward. I always aim to have a risk to reward for at least 1 to 2. So this was not a good trade. I wouldn't have taken this. But now let's go to the 4 hour to see if we can find a better entry. So here we're looking at the 4 hour, 240 minutes, the 4 hour time frame. So we take that high, and then we have that massive movement lower. And if you see this movement lower, price is showing its hand to you again that you want to go lower, seeking old lows. And this move you couldn't enter because there was no any retracement to go lower. But you could have entered somewhere in this price action. There were lots of times where every candle is 4 hours, so you have lots of time to get in here. So for example, your entry somewhere here, stop above the high, and then target the exact same lows as the previous trade. And now you don't have a 1 to 0.8, but you have a 1 to 3. And now let's play that game again on the 50 minutes, the short-term time frame. Now you're looking at the 50-minute time frame. So every candle is 15 minutes, and we took that high right here. And where was the massive move downwards? That was starting right here. When you see this movements in price, lower lows, lower highs, you know, okay, prices obviously want to seek lower prices. So then you can find an entry somewhere around here in this price action. For example, you've taken your trade somewhere right here, top loss above these highs. Then we're going to target exactly the same as the previous trades. They had a 1 to 20. So on the weekly, we had a 1 to 0.8 risk to reward. So that would have been a trade. It would not be any trade because that's just not a nice risk to reward. On the 4 hour, we already had a nice entry, but a solid 1 to 3. And if you refine it going lower to the 50 minutes, you have made a 1 to 20. And that's of course a very significant piece of profit. That means if you would have risked $100 on this trade, you would have made almost 20 times your money. In practice, in trading, you're not going to make 1 to 20s so many times. You need to hold this trade for multiple weeks. If you're a day trader, you probably will just stack up 1 to 2s, 1 to 3s on a consistent basis. But it's very important to see the difference between time frames. On the weekly, you would have missed that whole move. 4 hour, you could have caught a part of the move downwards. And on the 50 minutes, you have caught the whole range. And that's very important. So you know with your time frame alignment that you have one bucket from the higher time frame. In this case, the weekly want to go lower. The 4 hour intermediate term want to go lower. Your 15 minutes want to go lower. And if you execute on a 50 minutes based on that higher time frame idea, so that higher time frame is aligned with your execution on the lower time frame, then you have your high quality setups and you can catch those amazing 1 to 5s, 1 to 10s, 1 to 20s. In this video, we went over what a time frame is. So the time for a new candle to be printed on the charts. We went over how you can use time frames with the rule of 3 and how you can use that rule of 3 to make a high quality analysis on the charts. So by now, you should be able to explain what a time frame is, how you can filter between all the different time frames based on the 3 buckets, the higher time frame, the intermediate term time frame, and the lower time frame, and how you can use the exact framework of the 3 buckets with the rule of 3 to the charts to find some amazing entries on the lower time frame.
Third episode of the Beginner Bootcamp, we're going to talk about what to trade. We're going to talk about Forex pairs and the other liquid asset classes.
Before we dive into the pairs and the asset classes, let's do a small recap of the past 2 videos. By now, you should be able to understand and explain what candlesticks are and what time frames are and how to use them. For candlesticks, you need to know how to read them, how to trade them. You need to know how to apply the basic and intermediate level patterns. And you need to be able to apply the entry model given in the first episode of this beginner bootcamp. For time frames, you need to know what time frames are, how you can use them with the framework of the rule of 3. You need to know what type of trader you want to be and how that aligns with the time frames you need to use. And you need to know how to refine sniper entries using the rule of 3 in combination with those important levels. So in this video, we're going to talk about Forex pairs and other asset classes. First, we're going over what Forex pairs are. Then we're going over the majors, the minors, and the exotic pairs. And the third important question you need to ask yourself is, what pairs should I trade? And at last, we're going over the other asset classes you can trade. Let's start with the basics. What are Forex pairs? Forex pair is the exchange rate between 2 different currencies. In Forex trading, all currencies are traded in pairs because when you buy one currency, you are simultaneously selling another currency. And in this example on the right, let's say you're trading the euro dollar, so the euro against the dollar. The first one, the euro, we are buying that and simultaneously we're going to sell the dollar. We call the first currency that's on the pair, we call it the base currency. And the second one in line, we call it the quote currency. So for example, the euro dollar is currently worth 1.1000. That means you would need $1.10, the quote currency, to buy 1 euro, the base currency. When you're actually trading, you actually don't need these kind of detailed textbook explanations about pairs, but because this is a beginner bootcamp, I want you to have every single detail needed before you dive into the charts and actually going to trade these pairs. So again, euro is the base pair, dollar is the quote pair. When you're, for example, going to trade the dollar against the Swiss franc, then the dollar is going to be the base currency and the Swiss franc is going to be the quote currency. So then you're buying dollar and selling Swiss franc, but more on that later. Let's build on this foundation. If one of the individual currencies goes up or down, this will have effect on the pair itself. So for example, if the euro goes up and the dollar goes down, so the base currency goes up and the quote currency goes down, that means because you're buying the euro and selling the dollar dollar will go up. Vice versa, when the euro goes down and the dollar goes up, then euro dollar goes down because the base currency goes down, the quote currency goes up, then the pair goes down. But what if you have a situation where both euro and dollar go the same way? So both up or both down. Then euro dollar will be in a consolidation. That means it's going to trade sideways. It doesn't do anything. In these kind of scenarios, you don't want to trade because there's not much money to be made. Most of the money is made in those big expansion moves up or down. So it's always best to have one currency that goes up and one currency that goes down, or vice versa. And if you notice, the pair you want to trade has two currencies that move in the same direction, like this example, you should avoid trading the pair because it's going to be low probability and you're probably not going to make a lot of money. Now, when you know what Forex pairs are, you know about the base currency, you know about the quote currency. Let's talk about all the different currencies and all the different pairs and how you can categorize them. You have majors, you have minors, and you have exotics. Let's start with the major currencies. The major currencies are the currencies that are the biggest and are traded the most. And in this order is the US dollar, euro, Japanese yen, British pound, Swiss franc, Canadian dollar, Australian dollar, New Zealand dollar. And if you're going to talk about majors in pairs, we're going to talk about majors, minors, and exotics. Major pairs are the most commonly traded currency pairs. A quick side note, you can just remember that all the major pairs are the ones that are tied to the US dollar. These currency pairs typically have high liquidity, tight spreads, and average volatility. And these three conditions make the pairs nice to trade. So here on the right side, you see the different major pairs: Euro US dollar, Pound dollar, USD GSF, USD JPY, Japanese yen, USD CAD, AUD USD, and NZD USD. And this is how they are traded. So for example, maybe you noticed already, in most of the major pairs, the US dollar is the quote currency. Euro US dollar, GP US dollar, AUD US dollar, NZD US dollar. But in these three, the USD is not the quote currency, but the base currency. It doesn't influence how you trade, but it's good to know that, for example, GSF US dollar doesn't exist. So in this pair, US dollar is always the base currency. You cannot turn this around. So these are the majors. Then let's talk about the minors and the exotics. Minor currency pairs and exotic currency pairs have lower liquidity, wider spreads, and higher volatility. That makes these pairs still good to trade, but the majors just move cleaner and better. And a rule of thumb which you can remember from this is every non-USD pair can be labeled as a minor. So here you see no USD pair, here you see no USD currency. You have the euro against the pound against Japanese yen, the pound against Swiss franc. So the non-USD pairs are the minors. And then lastly, an exotic currency pairs is a term used to describe the trading of a developing economy's currency with a major currency. So here, Hong Kong, Singapore, South Africa, and the list goes on and on. Exotic pairs are also nice to trade, but keep in mind the exotic pairs are more difficult to trade, and that's because they are developing currencies. The developing economy's currency can either be the base or the quote currency. So now you know what a Forex pair is and how you can read them with the base and the quote currency. You know what the majors are, you know what the minors are, you know what the exotic pairs are. Then the question is like, okay, from all those pairs you've seen, like in the last 3 slides, you've seen like over 20 or 30 pairs. Which one of the whole list should you trade? And let's go over some ground rules here. The 6 pairs on the right amount to over 60% of the total Forex trading volume. So these are the most popular. And for newer traders, I would recommend to just stick to these 6. Euro US dollar is by far the biggest. US JPY is also very liquid, very big. So these two are the biggest. GU, so GBP US dollar, AUD US dollar, USGSF, and USD CAD. Keep in mind that each currency pair has its unique characteristics, benefits, and drawbacks. And you can compare this, for example, with your spouse. So, for example, you are trading the euro dollar the most, and you're dating this pair, and you have a nice connection, and you develop a relationship with euro US dollar. And just like you develop a relationship with your spouse, with your partner, you know when your partner is in a bad mood. You know when your partner is in a good mood. You know if your partner talks a certain way that you know, okay, there's trouble coming up, or maybe your partner's in a good mood. And you can see the same when you're trading pairs a lot. So if you have some months or years of experience with euro US dollar, you're going to see the unique characteristics. You know the benefits. You know when they trade, when it trades very nice. You know when to avoid trading euro US dollar. And the same goes for every pair. And here in this example, euro US dollar is the most liquid currency pair and has tight spreads, making it ideal pair for beginner traders. So I would say if you're a beginner trader, start with euro US dollar and with USJPY, and then expand to the other 6. And then a little extra here, where not many people are talking about, is the importance of time in your trading. Because you trade the Forex market, and that means currencies are traded when the specific market is open. So this is an example with the times when you are living in Europe. So for example, you live in London. And what's important to know is that at 8 a.m., so in the morning of London, the London Stock Exchange and the German Stock Exchange, the Amsterdam Stock Exchange, the biggest stock exchange from Europe, all are open at this time. Around the open, there's the most volatility. So that means trading in the London session, we call that, where all the European exchanges are open, is very nice for the European-based pair. So the euro US dollar, the GBP US dollar, for example, the USD Swiss franc. Swiss franc is also Europe. And for example, in New York, what pairs could be nice, or what currencies to trade can be nice in New York? For example, the US dollar, the Canadian dollar. And if you live in Asia, or you want to trade the Asian session, when all the Asian stock exchanges are open, so for example, the from Japan, from the New Zealand, from Australia, and you can guess it, that is nice to trade the JPY, or the Australian dollar, or the New Zealand dollar, because in those times, those pairs, those currencies move the most. So make it easy for yourself. Check for yourself, where can I trade? Where am I from? And what times can I trade? And then combine it with the pairs you would want to trade. So if you are able to trade London session, go for euro, go for GBP, compared, for example, with the US dollar. So trade euro dollar, GBP dollar, and also euro GBP. So aside from trading the top 6 biggest pairs, and also knowing what time you best can trade those pairs, the third framework you can use for the question what pair should you trade is the currency strength. So when you are doing your analysis, look for weak and strong currencies and try to trade a pair that has both a strong and a weak currency in it for the most clean moves. Now, what I mean by that, if you, for example, have the euro and the dollar, and the euro is very strong, very bullish, so it goes up a lot. And the dollar is very bearish, it goes down a lot. That is super nice, because the euro dollar will then go up like crazy, and you can have nice, clean, big moves, so you can make lots of money. And if you, for example, choose 2 weak currencies, so for example, both the euro and the dollar are both weak, then you have that same result as you had in that previous slide. Like here, when you have 2 pairs that go the same way, then you have sideways movement. You don't want sideways movement. You want big trending moves up or big trending moves down. So look at the individual currency strength. And a few pointers, these are 4 very important ones that I use in my own trading as well, are economic data. How is it with the inflation? Like, what's the status of the inflation? How is the unemployment? How is the GDP? Look for political stability or instability that can have an effect on its currency. Look at the rates, the interest rates. And when, for example, the rates are very high of a currency, then it's a very strong currency. And when the news comes out that the central banks want to cut rates, so they want to lower the rates, that will give a weaker signal to the currency. So if you, for example, have a euro that has risen its rates, so it's going up, this is a strong currency, and then the news comes out that the Federal Reserve, so the US central bank, is going to cut rates, then you have a strong euro and a weak US dollar, and you can anticipate higher prices for euro US dollar. And also, you can keep in mind the black swan events, the unexpected ones, like for example COVID a few years ago, and use this in your favor. And then lastly, some other liquid asset classes you can trade. You can trade the metals, so gold, silver, also copper. I like to trade only gold and silver. You can look at oil, also very nice to trade. Since a few years, you can also trade crypto, and especially Bitcoin and Ethereum. Those are the biggest, so that means the most liquid. Remember earlier in this video when I talked about the majors? Those are the big ones, the ones with the most liquidity, the most volatility, and so the cleanest moves. The same is for crypto. When you trade Bitcoin and Ethereum compared to like a random meme coin or a small cap, that just doesn't trade the same. So if you trade crypto, focus on Bitcoin, Ethereum, and you can also trade index futures. And index futures are the stock markets. So the Nasdaq, the US 100, the S&P 500. You can trade the Dow Jones, it's the US 30. You can also trade the German, the DAX, the English one, the FTSE, the Nikkei. That's the Japanese stock exchange. And you can do that in the form of index futures. In this beginner bootcamp, we're not going in depth into this, but know that next to the Forex pairs, you can also trade other liquid classes like these 4 types. And now let's dive into TradingView to see how all these pairs, so both the Forex pairs, but also these other liquid asset classes are looking like on the charts themselves. So currently you're looking at TradingView. This is the tool I use to do my analysis on. And on the right side, you see every single Forex pair and other asset class I am trading. So here I have the currencies. So the DXY is the dollar. The JPY basket is the Japanese yen. The BXY is the British pound, Australian dollar, Canadian dollar, euro, New Zealand dollar, Swiss franc. These are bonds. This is something for later. It's not for the beginner bootcamp. And I have these for my analysis for when I'm looking at my individual currency strength. So then I go, for example, here to the dollar, and I see this individual currency is currently, at the time of this recording, it's July 24. It's kind of weak for the last few days. So I know if I find a nice strong currency paired with it, so for example, the euro is very strong. We can take a look at that right now. Yeah, the last few days, the euro have been very strong. And you know, when you have a weak dollar combined with a strong euro, euro is the base currency. Dollar is the quote currency. So you know, euro dollar is then going upwards. And if we go to euro US dollar right now, it should be that the last few days, based on the things you just learned, euro US dollar should have gone up. And here you go. You have a weak dollar, a strong euro, and see how clean and fast this move upwards is. These are the currencies. The indices, and indices were the index futures. So if you want to trade the Nasdaq, this is the futures contract from Nasdaq. ES is the S&P 500. You see here in the small, you see the little logos, 500, 100. The US 30 is the Dow Jones. I also trade the FTSE, that's the UK 100. And of course, you also can trade the DAX, that's the German, I think the German 40. You can trade the Nikkei. You can trade the Nikkei, that's the Japanese one. And here you have the majors, Euro US dollar, GU, AU, NZD US dollar, the minors and exotics, the yen pairs. And here you have the metals. So for example, here gold is called XAU, XAU. So this is currently what gold looks like. Silver is XAG. And oil is CL1. And TradingView, you can just search oil. And here it is, oil, CL1. You can also type in crude oil and you find it as well. Just go here in the search bar or here in the search bar and type oil and you'll find the one you need. And lastly, Bitcoin. And lastly, crypto. Here, Bitcoin has been going down. You can trade Ethereum. You can trade Solana. I like to only use Bitcoin, Ethereum, and Solana for now. At the time of recording, these are the biggest 3. Maybe when you watch this, there are some different cryptocurrency that are very big and you can trade them. I like to only do Bitcoin and Ethereum and maybe some like Solana. So this is how it looks like. And from this baseline, I'm doing my analysis on a weekly and a daily basis. In this video, first we went over what a Forex pair is. You by now need to know what a base currency is, what a quote currency is, what happens when one of the currencies goes up and the other goes down. You also know now the majors, the minors, and the exotics, and also all the different tools. And also 3 different frameworks you can use when you're going to choose which Forex pairs you're going to trade. So focus on the big 6. Make sure you choose a time of day when the pair you trade is most likely going to move a lot. And also keep in mind that it's best to choose one weak and one strong currency so you have the cleanest moves with the pairs. After that, you saw how this all looks like in TradingView. And in the next episode, we will do a deep dive into TradingView, how to use it, so you can do this all by yourself.
Welcome to this 4th episode of the Beginner Bootcamp. And we're going to do a deep dive into TradingView. TradingView is the tool for your trade analysis and also for your execution. And after this video, you will know everything about it.
So when you go to tradingview.com, you'll see their homepage. You'll see the products, community, market, news. And the most important thing is you can use TradingView with or without account. I would recommend to create an account. It's free. If you press get started, you'll see free until you're ready. So you can use it for free and do analysis. There's so much different stuff you can do with the paid version. So I would recommend staying for free until you're ready and you notice, okay, I'm now at a level that I think I need it. And then just go for the essential plan or the plus plan. That's up to you. Pro tip here, don't go annually just yet. Go for monthly. And why you go to monthly? Every year during Black Friday or during some big holiday event, but most of the time during Black Friday, they will have like huge discounts on their annual plans. So I started with monthly, and then every year at Black Friday, I buy like maybe 1 or 2 annual subscriptions. So when you go press sign up, you can make an account or sign with Google. And when you've done that, you will go into TradingView. If you don't want to make an account, again, just go to products and here to charts, and then you'll be inside TradingView. So when you first started to TradingView, it will look something similar like this. Let's start with the settings here. So I'm logged in to the account, DionTrades, your home, help center, notifications, what's new. And currently I'm in the TradingView app. If you, for example, go to settings right here, you can go to dark, you can go to light. I like to use my system. So now it's light, your tabs, video and audio, your alerts, what sound it is. And in your browser, this settings will look a little different, but it's kind of the same. So if you, for example, want to go from light to dark because you think dark is more nice, you can find it here inside the app. And in the browser, it's, I think, somewhere here in this little section. Then here on the top left is the pair. In this case, it's Euro USD. If you want to trade, for example, Apple, you press Apple here. And the tip here, you don't need to click this and then type. If you are now in this screen and just go type, so I'm typing right now, then also this window will appear. Then there's a little plus icon. Now you can do a compare symbol, a little overlay. So if you want to compare Apple with Disney, for example, you have a little overlay between these 2 stocks. I never use this, but if you want to use it, go ahead. It will appear right here. If you want to delete it, you can press this trash icon and it's gone. Then you are at the timeframes. When you start with TradingView, these won't be here. You need to press this little down arrow and here you see all the timeframes. When you like a time frame, when you know, okay, I want to trade from this time frame, you can hover over your time frame and there a little star appears here. Because I have the star on, it will appear here. If I remove it, it's gone. And when you're in a free version of TradingView, these will all be free. But for example, if you go lower, for example, in seconds and some other time frames, they will be only for paid. But at the free version, you will be fine because based on what you learned during the time frame video from the Beginner Bootcamp, you only need the 1 minute, the 5 minute, the 15 minute for your short-term bucket, 1 hour and the 4 hour for your intermediate-term bucket, and the daily, weekly, monthly for your long-term, higher time frame bucket. Then here you can choose what kind of visual you want. Like you learn candles here, but you can also trade with lines, or you can trade with something like a Renko chart. I never traded this, so no idea how this works. I trade and I teach you guys via candles. So for example, we go to Euro US dollar. Now we are here. Then the indicators. So for example, you want to use RSI, or the strength index. You will see the native TradingView indicators right here. Also, some amazing traders and developers made their own indicators. So you see here the name, the username, and amount of likes this indicator got. So the more likes, most probably the higher quality of the indicator. So use this in your favor. So if you liked, for example, you can give it a star. And then if you go to your favorites, you can find them right here. So for example, I use these for my own trading. And then you can find them right here. If you have this arrow down, you can see your favorite indicators also right here. If you toggle them on, so for example, you have the kill zones indicator. This is the indicator and you will see them right here. So I have a watermark on right now. That is this under here where you see the Euro US dollar 50 minute. And here you can toggle it off. You can hide it. So now it's gone. Now it's on. See the settings from the indicator, and the same you can do for the kill zones or the other indicator right here on the right. Off. You can put it off, on, settings, and you can do the same for every single indicator. You can remove it with this. Then you can have your indicator templates. I never use this, but if you want to use this, go ahead. And then something very nice is setting alerts. So for example, here on Euro US dollar, you want to set an alert for when this high has been hit. You press alert on the price you want. So it's 1.0842, 1.0842, create. And now you see there is an alert here. So when price comes there, you will get a notification so you know when price has hit there. Then the most amazing feature about the paid TradingView is the replay button. So if you want to backtest and test your strategies, you get the replay button so you can replay price. So you can see if you were right or wrong when backtesting. If you want to redo and undo stuff, you can press these little arrows. And if you come here to the right side, this is your layout. So currently you only see one chart. If you want 2 charts, press here. And you can even do that until 16 charts. And then already you see I don't have that for my plan. And I think with 1, maybe 2, you already have enough. Then your different layouts. I use 3 layouts. I have beginner bootcamp, what I'm recording right now, live trading, and for the YouTube channel, different layouts. You can manage them right here. You can rename them, make a copy. You can export the data. You can create a new layout. If you want to have another one, if you want to load another one, you can do it right here. If you want to search something, you can do it right here. If you want to go to settings, your chart settings, you can find it here. So for example, for the symbol, you can change the color of the candles. So if you don't want red candles, but you want black candles, you can change everything here to black. And all the down close candles are black right now. And you can, again, redo this by pressing these buttons. And now its colors are back to normal. Then the status line, that's the top left here. Logo, title. You can play with scales and the lines. You can play with the canvas. So if you don't want a white background, but you want a green background, you can do this. Wouldn't recommend this, but you can play with it. You can play with the grid lines. So the grid lines are like this, or you want them clean. You can have a watermark. Everything is possible to change here. For your trading, you can have your positions, your orders. You can have events on your charts. So you just play around and do what you like and put the settings in place which you prefer. If you want to go full screen mode like this, you can do it with that button. Press escape to escape that mode. And this is very nice. A snapshot. So for example, when you have a nice analysis or you're taking a trade, if you want to screenshot this, you can go to the top right and you can do copy image. You can do download image. So that means it downloads it to your computer. You can copy image if you just want to just copy it. And now if I'm pressing paste, this image is too large, but if you want to paste it now in your editor, your journal, you can edit it there. Copy link. If you press the copy link, it will make a TradingView hyperlink. So if I do paste here, if you put this TradingView link in your browser, you will come to this exact screenshot. You can tweet it or open in a new tab. Publish is when you want to record something, speak your mind, publish an idea. I don't use this myself, but if you want to do it, go ahead. And now let's go to the nitty gritty of TradingView. On the left side here, you have all your tools you want to use. So for example, here you have your cross. That's what you see right here. You see me moving with my cursor, with my mouse. That's the cross. You also have a dot. Now it's dot. You can change it into an arrow. You also have the eraser. If you like certain tools, what you can do is hover over it and press the star. And if you press a star, a new toolbar will appear. And this one will stay forever. So you don't need to press like this all the time. You have just a little shortcut here. So if I want to go to the pointer here, I have it already here. If I want to go to the trend line, I have it marked out already here. Second one are the lines, trend line, ray line, parallel channels. Dependent on the language you want to speak with the market, so the strategies you're going to use, you will need different things. I only use the trend line. I only use the horizontal ray, and the vertical line. That's why there are stars here, and then they appear all right here at the toolbar. Then for your Fibonacci settings, Fibonacci retracement, you have all different kind of Fib stuff you can use. Also the GAN box. I use the Fib retracement and the GAN box for my own trading. But again, if you use other stuff like maybe the Fib spiral, you can just put it here and then you press it and you have a nice spiral. I have no clue what this does. It looks very cool, but you can use it like that. The patterns, if you, for example, are an Elliott wave trader, you have very nice tools right here. Also for this pattern, I don't use this, so that's why you won't see me having any stars in this section. Then a very important one is your protection. Long and short positions, most important ones. Long positions, you see the stars already here. And it's here in my toolbar. For example, if you want to take a long position right here, stop loss here, and you see this is how you show a trade on your chart. And if you want to play with this, with the settings, you can press it. Then the new toolbar appears here. You can play with the colors. And if you go to settings here, you have the inputs, so you can change the values. I would just change the values by doing this. So the gray area is your drawdown. Here's your stop loss in a long position. This is your entry. And your take profit is here when you have it like this. You press settings, style. You can play with the lines, with the stop color, the target color. So for example, with the stop color, I want to change it to pink. Also with some nice transparency, you can do it like this. You can color it the way you want. I'm going to press undo again. So play around with that, whatever you want, which colors. both for longs and also if you want to go short, same. Stop loss here. You can play with take profits, wherever you want to take a trade. Then the brushes, arrows, and shapes. I use the brush, I use the arrow, the rectangle, the path, and the circle. Also the curve. For example, a rectangle is very important. For example, for your support and resistance area, supply and demand. You can make a rectangle like this. And then you have again those settings. So for example, if you want a nice color, or green, or like a little purplish, just play around with that. Here, you have your text and notes. What I like to use is the text and the call out. A text here, and here you can play around as well with both the colors of the text. So if you want the colors of the text to be pink again, like this, and the background needs to be black, you can play with the transparency. You can adjust settings as you like. Then here you have your smileys. I don't use this as often, like for example, the dollar smiley, so you know where liquidity is, where money is, or you just want to play around and you have some nice unicorn model. You can play with the unicorn here. But for your trading analysis, of course, you don't need this. Then these are very obvious. This is your measuring tool, your zoom in, your magnet. The magnet mode snaps a drawing placed near price bars to the closest open, high, low, close. I don't use this that often. You can stay in drawing mode, lock all drawings, hide all drawings. So if you want a clean chart immediately without removing all your stuff, if you actually want to remove everything, you can press this. You can choose to remove the drawings or the indicator or both. So for example, if I want to remove only drawings, now those are gone. So now you know how the top bar works. Now you know how the toolbar here works. Now let's talk about what's up here. Here you see the pair you're trading. So for example, this is Euro US dollar on the 50-minute time frame. And here you see the broker. If I go again to Euro US dollar, you see here the pair, what it is, the description. And here you see different names. These are the brokers. And you're free to use which broker you want. I use Forex.com, but Owenda is good. FXCM is good. A recommendation here, when you're going to make your watch list, try to have all the pairs with the same broker, so the data is best aligned. So pair, time frame, broker. Here you see the open, high, low, close. Remember from the candlestick video that every candle has an open, a high, a low, and a close. So for example, if we are at this candle, we know the open is down here, the low is here, high is here, and the close is here. And now if you look at the open, high, low, close values in green, you will see the open was 1.0838. You see the high was 1.08420 and so forth. So if you want to check that, you can just hover over it with your mouse. So if you go to this candle, it's different. In the red candle, the numbers become red. So use in your favor with your analysis. Here you can buy and sell via TradingView, and your indicators are right here. If you're using oscillators, your indicators can also appear at the bottom, but most of them will just appear right here. And then on the right side here, you can toggle this on and off at the top right here. Watch list details and news. Here you can make your watch list. If you watch this, if you want to make a new watch list, create new list. It's called as beginner bootcamp. And then you have a whole new list. If you want to add a pair to this list, so for example, Euro US dollar, you can press this plus icon. You can press Euro US dollar with the broker you want. So for example here, and you can press this plus or just click on this and it will appear here in your list. If you want to have multiple, so for example, also GBP, USD, same. And now you have two pairs in your watch list. What you even can do here is add a section. So you can make different sections. So for example, you say this one is the majors, all the USD pairs. And then if you have a new section with exotics, you can make a new section. Double click with exotics, and then you can place your exotic pairs here. So you're making a whole list. That's what I did here with the Forex pairs, currencies, indices, majors, minors, exotics, yen pairs, metals, crypto. So it could look like this. You can play here with the columns, which you want here, but I like to have it kind of clean. So I toggled all of this off to make it just the pair's name, and that's it. You don't want any table view, just do it like this. But you can play with this again, how you like the layout. The advanced view I never used. If you press this, you see a lot of information. Do with this whatever you want. You can exit this by pressing the X button here. And this is for your watch list. The rest of this I don't use too often. Alerts. Here you can see all alerts you have. So if you made it alert, for example, at the high here, it will come in this list. The pro tip here, if you have some lines marked out. So for example, I do now a line at this high. So I click, mark it out. I can play with the settings. So for example, I want a dotted line. I want it to be very big. But I want at this line, when it reaches here, I want an alert. What I can do then is press it. And then here, add alert. And then already all the values are there. And then create. And now you see it's created. You want to remove this. You press this icon. And it's gone. And in the meantime, it came here. So now if I remove it, now it's gone. You could also do it by right click, add alert, same stuff. A data window I don't use. Hot lists also not. And the rest is just an extra I never used before. Then here at the bottom, you have the 1 day, 5 day, 1 month. Here you can go back in time. So here, if you press the button, you see the last year. Now it's quite ugly, right? You can double click here on the right side to have it better. So let's do it again. If you have a bad layout, you can just double click. It will reset your chart view like this. And then you're back at your regular layout. So you can do this by double clicking here, but also if you hover your mouse over your layout, over your chart, double click. If you do right click and then reset chart view, it resets for you. And you can play with your mouse to get a nice view as you like it. So if I want to go back, now it's July 2024, if I want to go back to, I don't know if there's data for this, but let's say it's the 1960s. No, there's no data for this. But so let's say we want to go back to January to December 1st of last year. Then you are right here. This is your December 1st. Then here you have some remaining tools. Stock screener. I don't trade stocks, so I don't use this. A Pine editor if you're a coder. Strategy tester. I never use this myself, so you can open this by just dragging it. And the last thing is the trading panel. If you want to demo trade, that means you're not trading with real money. I would recommend, this is from TradingView itself, is pressing the paper trading account. If you make an account here on paper trading, you get an account with it, whatever you like. So let's connect. I use this sometimes. You see a big balance. You can choose your balance. So paper trading, your settings here, account, and then create a new account. Name beginner bootcamp demo. And for example, you want to start with a $1,000 test account, create, and now you can take real trades. Let's minimize this a little bit by dragging this out. Reset view, so we go back to the present. Let's go, for example, to the 5-minute time frame. The market is now closed at the time of this recording because it is Sunday. But if you want to take a trade right here, something like this, 1-to-1, of course, not a very nice trade. Then you can press the buy market, and then it will buy the market, and it will give an error because the market is closed, rejected off trading session. Sunday. But when the market's open, you can actually take a trade, and it's just on the demos, fake money. So you can just try and get your first trades here to practice. And that's it for TradingView. So again, top bar, you know the time frames, the indicators, the replay button, alerts. You can play with the layouts here. The whole toolbar, if you like some tools, hover over them and put the star icon in. So you have the toolbar here. So you don't need to go to this left side the whole time. You can just press it right here. You can just find your tools right here. On the right side, make your watch list. You want screenshots, you can do that here. And at the bottom side, if you want to go to a certain date, you can go here and open a paper trading account with a nice new demo account to put your first trade in without risking real money. And as a final note, some TradingView shortcuts. My favorite is the shift for drawing a straight trend line. So for example, you have a line and you want to draw it out. Now it's not very straight. If you press the shift button, it's now straight. If you release your shift button, it's not straight anymore. And next to this, there are amazing other shortcuts to use to make your life on TradingView easier. In this video, we deep dive into everything TradingView has to offer. So you don't need an account. When you make an account, go for the free version. If you're ready to go for the paid version, only do monthly and wait for that nice juicy Black Friday discounts to put your annual subscription on. If you're inside TradingView, you now know every single detail. So you know how to use the time frames, you know how to use the indicators, how to do an alert, how you can make screenshots, how you can make a watch list, how you can use your toolbar, everything you need. And now you can even use paper trading, the tool where you can create an actual demo account so you can place your first trades. You can finally place your real trades without the risk of losing real money.
Welcome to this 5th episode of the Beginner Bootcamp, and we're going to talk about market structure.
In this episode about market structure, first we're going to talk about what an uptrend is, so when you're moving upwards, how you can spot a downtrend when you're going downwards, how sideways movements look like, and then we're going to talk about a break of structure, so when an uptrend changed in a downtrend, or vice versa, and we're going to combine market structure with the previous learned about timeframes. First, let's go over the basics. Price basically does only 3 things. It's going up, in an uptrend, going down, in a downtrend, and going sideways, doing nothing. So you will see price going first up, then down and sideways, or then up, sideways, down. There is no specific order when this is going to happen. But now let's look at each of the 3 trends and see how you can spot them and also when they are changing with the market structure shift. First, let's go over an uptrend. How you can spot an uptrend looking at market structure is marking out highs and lows. And if you, for example, here look at this movement upwards, you see based on the candlesticks that we're going upwards, right? But how can you use market structure to put a framework around this? Here you see a high, a low, and we're going higher, making a higher high, Then we're making a higher low. Why is this a higher low? Because this low is higher than this low, than the previous low. Then we make another higher high. Why is this a higher high? Because this high is higher than this high. We make a higher low. Why? This low is higher than this low. Make another higher high, higher low, higher high. And we can do this till infinity. Perhaps a question you might ask, for example here, why is the higher low mark at this low and not, for example, at this low? And why this is you need to look at swing lows. And what a swing low is the low in this exact swing. Lower to go higher. And how you can identify a swing low is a low with a higher low to the left and a higher low to the right. Then it's a swing low. You see it here as well. Low right here with a higher low to the left and a higher low to the right. And the same at the highs. We have a high here with a lower high here and a lower high here. That's a swing high. So with finding an uptrend, you need to mark out your higher highs, your higher lows. Vice versa for a downtrend. You see, based on the candlesticks, that we're going lower. Let's mark them out with a high. A low, we're going lower. So we're making a lower high. This is a swing high. Why? We have a lower high to the left and a lower high to the right. Swing high. That's why we marked it out here as well. Here's a low. We make a lower low. We make another lower low. Make another lower low. Here, lower high. We make another lower high. This close here, but this is a lower high to the left, lower high to the right. That's why this is a swing high. Another swing high, lower high in a downtrend. So now you know how to spot an uptrend with higher highs, higher lows. Now you know how you can spot a downtrend with lower highs and lower lows. And the third possibility is sideways movement. And marking out highs and lows is quite difficult here. Why? For example, here is a high. Here's a low. Here we make a lower high. So that would indicate we're probably going into a downtrend. So we are seeking a lower low. But we don't have that because here's the last low and we make a higher low. So we have both a lower high and a lower low. Then you make a higher high, but then we make a lower low. So because of this price action, this is low probability and you should avoid this price action. So if you see this in your chart, just avoid trading this. Keep trading a downtrend and an uptrend because in those moves, you can make the most money. If you're an uptrend, you can go long, going up. If you want to go short, do it in a downtrend. Sideways, stay off the charts. Marking out highs and lows is very difficult and just avoid this overall. Then let's talk about a break of structure. So when you're going from an uptrend to a downtrend, how can you spot around this piece of price action that we're probably going from higher highs and higher lows towards lower highs and lower lows? So in a downtrend, here are 2 pointers you can use to predict this. The first one, wicks go through previous highs and lows. So what you see in this uptrend with clear higher highs, higher lows, higher highs, higher lows. And then right here, at this piece of price action, you see this massive wick upwards. Remember from the candlestick video, price starts here with the open. It goes all the way up, but then it goes all the way down, closing right here. So there's lots of sell pressure here. So yes, we took the higher, so we made a higher high. But because of how the body is closing, you can see this as a weakening of the trend because we were moving upwards with the trend, but then huge move downwards. Open, high, low, close. And also you will see higher highs, higher lows, etc. being disrespected. So in an uptrend, you want to see higher highs, higher lows, higher highs, higher lows. But when the trend is weakening, you will see not a higher high being made and a higher low, but now you will see a lower low being made. There you know, hey, that's very interesting. We're probably going to change the trend right here. So for example, the wick is not very long, but it doesn't take out the high. So you have a higher high, higher low, higher high, higher low. But then this candle, because this swing high, remember, fails to create a new higher high, we call that failure a failure swing. So this swing high fails to take out this high, so it fails to make a higher high. We call this a failure swing. And after that failure swing, you see that movement downwards. And price creates now a lower high, then it goes to a lower low, lower high, lower low, and it goes downwards. So in this piece of price action is your break of structure. And then is the question, when is structure broken? And you can choose two areas right here. The main rule is that there's a break of structure, for example, here an uptrend, when the last higher low has been broken. So in this case, it can be this higher low or this higher low. So you see this massive move downwards, and you know, okay, in this piece of price action, I can go look for shorts instead of longs because we broke structure. And if you want to annotate everything, higher highs, higher lows, everything, break of structure, failure swings, it will look like this. Higher highs, higher lows, uptrend. Then it makes a lower high, a failure swing, higher low. I like to mark out when this higher low has been broken at this break of structure, but you can also use this candle as your break of structure. That's up to trader discretion. So look for the last higher low to be broken. And then you know, okay, we're probably going down for a while until these lower highs, lower lows are not respected anymore. And we start making higher highs and higher lows again. Like we did here. We're going back in an uptrend. So now you know how to spot an uptrend, how you can spot a downtrend, when there's sideways movement, and also when there's a break of structure. Then it's very important to combine the lessons from the previous episodes. So you know what a candlestick are, you know what pairs are, but you also know what time frames are. And the main rule for market structure is, and how you can trade that, is the trend is your friend. So high probability trades is when you have the three buckets, so higher time frame, intermediate term time frame, and lower time frame, if every market structure aligns. So for example, on all the three time frames, we going up. That's very nice. You can trade that. But what if on the daily we go up, on a 1 hour we go down, and on a 5 minute we go sideways? That is possible. Then you know, okay, maybe I should wait before the trend is aligning itself again with all the three time frames. Remember the rule of 3, you need to keep applying that to your trading. Now let's dive to TradingView to see some examples. Currently, you're looking at the euro US dollar on the daily. We're looking at a live chart. So we're now at July 2024. And here on the daily, we were here in an uptrend. Higher highs, higher lows. But then right here, we had a higher low. But then it made a lower high. And then a lower low. Then a lower high. Then a lower low. And then right here at the current price action, we had some consolidation, some sideways movement. But you saw here, we made a lower low, then a higher low with higher highs. So now, recently on the daily, we are back at an uptrend. So we marked it out with an uptrend. And now let's look at the 1 hour and 5 minutes. So 2 time frames from the other 2 buckets to see if the trend and our market structure aligns with all the 3 time frames. So here we are at the 1 hour, and you see we're making a lower low, higher high, higher low, higher high, and so forth. So here you can see we are currently also in an uptrend on the 1 hour. And now let's dive into the 5 minute to see if we also have an uptrend. So we know, okay, we can safely, with the trend, with our structure, place long positions in the market. And now we are at the 5 minute time frame. So again, at the 5 minute time frame, every single candle is 5 minutes. So now you see we have some sell-off here, but then here we made a lower low, but then a higher low, higher high, and so forth. So now we are also in an uptrend. So in this piece of price action, it's currently, the time is here 2:20 New York. So that is the London morning. At this time, the London Stock Exchange goes open. Remember from the pair video is you need to trade when the stock exchange are opening. So the London Stock Exchange opened in this price action. And you see we had some sells here, but then we had that bullish engulfing candle. The candles fail here to go lower. See that bullish engulfing candle upwards, making higher highs, higher lows. So, you know, in this piece of price action, you could have taken a long position. And that long position on the 5 minute is completely in line with your other 2 buckets, with the 1 hour in this case, and also with the daily. So these long positions are very nice to take. And here we are at the euro US dollar at the 1 minute chart. We see exactly the same price action as we saw just now on the 5 minute. But there's one important note you should remember here. The lower the time frame, the more break of structures you will see. So for example, in this piece of price action, this is midnight here, we have a few hours of price action here. And in those few hours, we've seen a downtrend, we've seen an uptrend, we have seen some sideways movement. And most new traders go to the chart immediately to the 1 minute because more candles are printed, there's more price action, and they're just completely lost on the chart. Because they're like, oh, I'm going to short here, we're going lower and lower, lower. And then they get stopped out by this movement upwards. because they don't trade with the higher time frame trend in mind. So always start at the higher time frame, your higher time frame bucket, daily, weekly, monthly. For intraday traders, just do daily. That's fine. Is the daily going up? Then look if your intermediate term and short-term time frame are aligning with that upwards momentum. It is very hard to short a move on a lower time frame when on a daily, weekly, monthly we're going up. Yes, you can make money, but the highest probability trades, so the trades where it's most likely that you're going to make money, are with the trend. If you like this beginner bootcamp where you learn every single puzzle piece that you need to become a trader, then you're definitely going to like the 2024 mentorship. Inside the school group under Classroom, you can find the free 2024 mentorship right here. And in this 2024 mentorship, there are 40 plus videos that help you further develop your understanding about trading. And next to the 40 videos, there are community posts about COT reports, psychology, there are bonus episodes, there are entry models for you, so everything you need to become a better trader. When you've completed the beginner bootcamp and also the 2024 mentorship, you are at an amazing level to start leveling up like crazy. Then the inner circle mentorship comes in. This will be a private mentorship where me and my team are going to make you a beast of a trader. We're going to focus on how you level up in life, going over your psychology, discipline, your consistency. We're going over your trading plan. We're going over journaling, trade management, over getting funded, getting payouts, and everything you need to become a professional and profitable trader. You can enroll for the mentorship in the link in the description. Let's get back to the video. In this video, we went over the basics of market structure. By now, you know what an uptrend is, what a downtrend is, how you can spot sideways movement, and with those trends, how you can identify higher highs, higher lows, lower highs. You also know what a swing high and a swing low is. And on top of that, you also can identify a failure swing. So when it's most likely that the trend is going to be weakening. Together with the 3 different types of structure, up, down, and sideways, you also know when a break of structure happens and how you can use that market structure together with the market structure shift, so the break of structure, how you can combine that with the time frame alignments from the previous episode. Welcome to the 6th episode of the Beginner Bootcamp Trading Indices. In this video, the first thing we're going to discuss is what are indices. Then we'll go over the 3 biggest indices, the Nasdaq, the S&P, and the Dow Jones. And of course, the most important one, how to trade them. Sources are from both Investopia and Barchart, so shout out to them to providing some nice information. What are the index futures? Index futures are contracts to buy or sell a financial index at a set price today and are settled in the future. These contracts were initially meant only for the big boys, for the institutional investors, but have been opened for decades to anyone. So what we do basically, we say today we think, for example, Nasdaq is worth 20,000, and in the future we probably say it's going to be 21,000. So we're setting for the future. Portfolio managers use index futures to hedge their equity positions against a loss in stocks. Speculators, that is us, can also use index futures to bet on the market direction. This is what we do. The most popular index futures are the Nasdaq, the S&P, and the Dow Jones. Those are all US based, so America based. You also have non-US futures, for example, the German DAX, the English one, the UK one, the FTSE, and the Japanese one, the Nikkei. In this video, we're mainly focusing on the US ones. Let's talk about the Nasdaq. The Nasdaq is the top 100 companies in the US, and mostly they are tech companies. And the top 10 companies you already see is Apple, Microsoft, Nvidia, Amazon. I think you recognize them. And here you see the sectors, and you see 62% of the whole Nasdaq is technology, then consumer, then healthcare. But you can just remember that the Nasdaq is just the tech companies. So that means when tech companies rise, like for example, recently at the time of the recording is 2024, Nvidia had like a massive run. The Nasdaq is just shooting up. At the same time, when rates are high, when the economy is slowing down, when capital is harder to grab for investors, you see tech companies having a rough few months, and you see the Nasdaq declining as well. Then the S&P. In the futures, S&P is also ES. So if I refer to ES, I mean the S&P 500. The S&P 500 is the top 500 companies in the US with many similarities to the Nasdaq, but there are more companies and it's balanced through more sectors. So you see again, Microsoft, Nvidia, Apple. You see most of the tech companies in there, but you also see Berkshire Hathaway, insurance and investing, JP Morgan, bank, ExxonMobil. So a little different. And you see here only 33% against 62% on technology in the S&P, financials, healthcare, little different composition. What you can already remember from the S&P and NQ is that they move the same. In general, you see when the S&P rises, Nasdaq rises and vice versa. Then the Dow Jones is composed of 30 videos, and we also call it YM. That's the ticker. So where the S&P had ES, where Nasdaq has NQ, Dow Jones has a YM. And 30 companies, you see them all 30 on the screen. You don't need to remember what 30 there are. You just need to know that there are 30 companies, like with some similarities, but also some difference between NQ and ES. For example, Boeing, Chevron, the Dow itself, IBM, McDonald's, SP, and the Dow Jones are the two most watched stock indexes in the US, Indices. However, these two are benchmarked very differently. The Dow Jones tracks the 30 large cap stocks, while the S&P tracks the largest 500 stocks. That is already difference, 500 against 30. The Dow Jones index is price weight, while the S&P 500 is market cap weight. So the price of the Dow Jones is based on the price of the stocks, and the S&P is based on the market cap of the individual stocks, so what it's worth. The specific stocks are inside the indice. In the Dow Jones, they are chosen by a committee, and on the S&P 500, they are added according to a formula. So if your company gets bigger and bigger, eventually you will get into the S&P 500 based on the formula they are used. And if you want to be in the Dow Jones, you need to be chosen by a committee. Again, guys, this is all theory. For your actual trading, you don't need this information, but it's nice to have some background information of the specific asset class you are trading. And now let's go into the more juicy stuff of the video. And that's how to trade the indices. We're going over index contracts, we're going over TradingView, we're going over their movements, and also we're going about news. So when to trade them, where's nice volatility. And the starting point of future contracts is barchart.com. Very important website when you're going to trade futures. Barchart.com, go on top to futures and then press indices. There's where you want to be. Index future contracts allow investors to make trades on various indices based on their predictions about the overall price movement of the particular index. In other words, we as traders speculate on a daily basis or weekly basis. If we think price is going up, then we go long, or we think price is going down, then we short. Future contracts involve margin. Margin means leverage, and leverage means that investors and traders can trade much larger amounts of money than their actual available capital. And that's very nice. That means if you have $1,000 in your capital, then you can play with times 100. So you can play with $100,000. More about leverage in a later part of this beginner bootcamp. So when you get the bar chart and you press futures indices, you will see this little schematic. And I want your eyes to go towards the volume tab right here. And why? Every 3 months, a new contract goes live. So that means in March, we have a contract. In June, we have a contract. In September, we have a contract. And also in December. For March, it's an H. For June, the ticker is M, September is U, and December is Z. So you will see here, the time of the recording is July 2024. So you see the volume is very high right here at the ESU 24. That means ES is the S&P, U is September contract, and 2024. So S&P September 2024 contract is live right now. Later this year, December contract will go live, and then we have ESZ 2024. And you will see in your chart, when your contract is expiring, you will see the bodies of the candle being a little blurry and not complete anymore. And you will know, okay, now I need to change towards a new contract, or just know every 3 months, just roll. It's called a rollover of the contract. Then you go from the September to December. After December, you're going back to March. Same for NQ, for example, 106 is a lot of volume. NQU, so NASDAQ, September 2024. Every trader uses TradingView as their main tool of analysis. And when you want to trade the index futures on TradingView, by default, you will see this S&P 500 futures, and then you will see this orange D appearing. And it says ES data, and this example is S&P. ES data is delayed by 10 minutes. To get real-time data, please buy the real-time data. So if you want to see the future data without any delay, without any 10-minute delay, you have to get CME data on TradingView. It's a few dollars per month. You can get it on tradingview.com/CME. And I can understand that you are just dipping your toes into futures. You don't want to pay any extra. And until you're actually trading futures, you're going to take your trade real money. You can use the free ones. It's US 100, US 500, and US 30. The only difference is the numbers, and also the price action can be different sometimes. And what I mean by that is, for example, on the futures contract, we have lower highs, lower lows, downtrend. And sometimes we have an explosive move upwards. So we had one more sweep of this low, made one more lower low before the real move upwards. What sometimes happens is the future contract on the free one, what you will see is same lower lows, lower highs. But without that lower low being made, the move's already done. And if in your trade plan, what you're going to make, one of the things you want to see is that sweep of liquidity that one more lower low being formed before the real move, you were not in this move just based on the fact that you didn't have the real-time CME data. This happens sometimes, so that's why I highly recommend when you're going to trade the indices, go use the CME data. And now let's hop into TradingView to see how you can trade the indices in real time. Now we're looking at TradingView at the NQU 2024. That means the Nasdaq September contract from 2024. And the same is for ESU, YMU, and it's the CME data. You can also go for the free one. So for example, you want to have the free one of US 100. There we go, US 100 from capital.com to the daily. And this is same chart from Nasdaq. And you can see it here already, the example I gave in the slide. You see the Dow movement, right, for the last few days. But look at the low here, the Monday 24 low right here. US 100 did not take this yet, but here the future contract did. So if you want to, for example, take a long position from this point, if in your trade plan says there needs to be a lower low before I take the trade, if you don't have the paid data, you won't have the information. Also, what's different here, you see the numbers. It's currently 19,713, and here it's 19,519. The numbers are not the biggest problem. It's the problem in the price section with the highs and lows. So keep this in mind while choosing if you want to get the CME data or not. And again, I would recommend to get that few bucks a month data. Now you know about the future contracts and about TradingView. We're going to talk about the basics of how indices move. And what you should remember is the indices rise slowly and fall quickly. A nice quote from this is, the bulls, so the buyers, come with the stairs and the bears jump out of the window. Bears are the sellers. You see staircase upwards, little upwards, higher highs, higher lows. And then when indices fall, they fall very quickly. But know that over time, since they exist, they've been going upwards. And a very important note here, for day trading, it does not matter if you're going long or short based on a long-term trend. You know indices will go up over time. But you can go long, you can go short. And the amount of up days, so green days, and red days, down days on specific indices are around 50-50. But over time, you will see that the green candles are bigger than the red candles. So over time, the trend will go up. And at last, talk about news. Very important in your trading. The indices are a fraction of the stock market. That means when economic conditions are good, the specific indice will go up. Vice versa, when the economy is very bad, you will see the indices falling. Important news indicators. First is GDP, the bought goods and services. NFP, the job growth over time. Interest rates, when you have low interest rates, you will see the market going up and vice versa. And important are company earnings. So for example, when Nvidia has amazing earnings, they made a lot of profits, made lots of money, you will see that it has a positive impact on a specific index. Nvidia is a tech stock, so the Nasdaq will most likely go up. In this video, we first went over what indices are. We went over the Nasdaq, NQ, and YM. Then we went over the future contract, about the change of the contracts every 4 months with their specific ticker, and you can find it all on bar charts. We went over TradingView. You should make the decision if you want to use CME data, yes or no. We went over the movements, that the bulls come with the stair and the bears jump out the window. And we went over the importance of news with trading indices. All right, welcome to the 7th episode of the Beginner Bootcamp, Leverage. Everything you need to actually place your first trades. Let's start with a small recap. By now, you should know how to read candlesticks and their respective patterns. You should know what timeframes are with the Rule of 3 framework. You should know what to trade on the Forex market and indices. You know by now how TradingView works. You know what market structure is and how to use it. And you know what futures are and how you trade them with the indices. In this video, we're going over what leverage is. And specifically, we're going to talk about pips, ticks, points, lot sizes, and we're going to do some calculation on this. When I started to trade, when I was ready to execute my first trade, I went into my TradingView app, I went to my MetaTrader app, and I was ready to take a trade, and I didn't know what to do. And there's where the pip, ticks, and points come in, and how you can lot size, because what do you actually buy or sell? That is where this video comes in. First, let's talk about what a pip is. The term pip is commonly used in Forex trading, so with the Forex pairs, and 1 pip is indicative of the smallest price move of an exchange rate can make. So if you want to go long, you want to collect pips. You want to take as many pips as possible, because the more pips you can grab or surf the wave with in the trading market, the more money you make. It is determined by market conventions and is always right of the decimal point. Typically, currency exchanges used 4 decimal places. So the smallest change will be in the 4th place, or in other words, 1% of 1%. And for example, euro US dollar, current price is 1.08829. In the 4th place after the comma, so 1, 2, 3, 4, this is your pip. So when this goes to 3, it's plus 1 pip. If it goes to 1, it's minus 1 pip. The amount of money that's associated with the change in pips is completely determined by the currency pair in question. So the main rule for Forex pairs is what we just discussed. The 4th place after the comma. So when you go plus 1 pip, it goes from 1.08829, it goes to 1.08839. But for example, use JPY. JPY pairs only have 2 decimals after the comma. So for this exception, for the JPY pairs, the last digit is your pip. So when it goes from 157.35, when it goes to 157.36, you have plus 1 pip. So now you know what a pip is. Let's talk about what a tick is. Where pips are used in Forex trading, ticks are used in futures trading. The tick is indicative of the smallest possible price movement and is right of the decimal. It means that there is not necessarily any standardized amounts across various markets, as the market can choose to set the minimum price movement at any amount that they please. The movement value of a tick is called tick value. If we look at the tick value in trading, S&P, crude, and gold, they're all different from each other. So the S&P and the Nasdaq, the tick value is 0.25. Oil ticks are 0.01 and gold ticks are 0.1. You don't need to remember everything about this, and I will show you later in this part how you can see this actually in TradingView. Now you know what a pip is with Forex, you know what a tick is with futures. Now we're going to talk about what a point is. And a point is used in multiple ways. First of all, it refers to the left side of a decimal point and is the largest price change of the 3 measurements. So when we talked with ticks and pips about the right side, with points you talk about the left side. A point is usually made out of 1,000 of ticks. Usually the term point is used by traders to describe price change in their markets. Specifically, it is used when describing the changes in price in futures markets and is created by the exchange setting dollar values to correspond with the movements in various instruments. Lots of textbook, guys, you don't need to remember this. Also, you will hear individuals trade stock markets use this term to describe how many dollars a stock have moved up or down. So for example, Tesla goes from 249 to 250. It goes plus 1 point. So when you are trading futures and you hear someone talk about, yeah, I made so many pips, you know, hey, this is not an experienced futures traders, because in futures, we use ticks and points. It's not too important for your trading, for your actual trading, your execution. You need to just collect ticks, pips, or points to make money. So let's talk about that right now. Together with pips, we want to collect pips. So we want, for example, you want price to go up 50 pips. If you want to go long, and if you want to go short, you would like to have 50 pips short, or of course more. What you actually buy is lot sizes. You buy contracts, and you have 3 different lot sizes. You have a micro lot that is 0.01. You have a mini lot that is 0.10, and you have a standard lot is 1.00. And in this scenario, we have the euro US dollar from earlier, 1.08829. And let's say it goes up by 1 pip. How much money do we make using 1 micro lot? So by 1 micro lot, you buy 1 mini lot, or you buy 1 standard lot. That means with a micro lot, you buy 0.01. So what that means is you buy a micro lot, for example, is 1.01. You buy 1,000 of that currency. So if you want to buy 1 micro lot based on the current price, you need to have $1.088 to buy 1 micro lot. That means when price goes up by 1 pip, you will make 10 cents. Same for a mini lot. You buy 0.10. You buy 10,000 of that currency, and you need 10,883 for 1 mini lot. If price goes up by 1 point, you will make $1. Standard lot, 1,000 currency, you need 108,000 for 1 standard lot. And when price goes up by 1 pip, you make $10. Let's go dive a little deeper into the calculation of this. Because when you're going to trade, you're going to have different amounts of leverage. And leverage, we touched upon this earlier in the bootcamp. That means, for example, if you have a 1 to 100 leverage, that means when you have $1 of your own, you get $100 to play with by your broker. If you have $1,000 of your own money, you can have times 100, 100,000 to play with. So for example, when we looked at buying one standard lot, we need to have over 100,000 to buy one standard lot. I know that 95%, maybe more of the traders don't have 100K laying around to put into their trading. And there leverage comes in. Because with leverage, with the 1 to 100, you only need 1,088 times the 100 leverage to get to that one standard lot. And that's very nice because now you can play with the standard lot and can actually make money. If you, for example, have a 1 to 30 leverage, that means $1 of your own money is $30 to play with, or $1,000 of your money, you have $30,000 to play with. Your opportunities are going to increase because, for example, in the previous example, if we again want to buy one standard lot, we need 108,829. But with the 1 to 30 leverage, we don't need that whole 100K. We only need 3,627 to buy one standard lot. So the more leverage, the less money you need to buy a lot. Of course, this also has a downside because the more leverage you use, when price goes down, you also lose more money. But in general, with good risk management, what you will learn as a developing trader, it's very nice to have high leverage because you just have more opportunities to make money. To add a little note to this calculation, the code currency you were using is important for the calculation because in all the previous examples right here, we all use US dollars. So for the USD pairs, so XXX, for example, Euro, US dollar. But what if the code currency is not the US dollar, but the CAD, JPY, or AUD, XXX CAD, or JPY? So a Euro CAD or USD JPY, how do you calculate it then? And then you have uneven numbers and it's quite difficult to calculate. So when your brain is like, oh shit, I want to be a trader, I don't want to be like a math guy, I got you. Because as traders, we don't calculate this manually. We have tools for this to do the heavy lifting. And let's talk about that right now. You can start by just Googling lot size calculator. The one I like to use is my FX book position size calculator when I am on my computer. And on my phone, I like to use Stinu. It's both for Android and for your iPhone. And Stinu is like, I think, $10. This is free. But when I am trading on my phone, I like to use this very quickly. It's a very nice tool. And let's take a look at my FX book to see how this actually looks like. But before we dive into the lot size calculator, we need to know what trade we're going to take. So for example, you are here at TradingView and time recording is Sunday, so the market is closed. But hypothetically, we want to take a trade right here. So we think price will go up and we want to put our stop below these lows. And if I hover my mouse around this, you will see here at the bottom, you'll see stop says 0.0007. And you know, the fourth decimal of this pair is a pip. And after that, you see 7.0. That's the amount of pips. So when you're looking for the amount of pips to trade with, my stop loss now is 7 pips. Let's aim for a 1 to 3. That means, for example, if I want to risk 100 on this trade, when it goes to my take profit up here, I make $300. But when you have 7 points risk and a 1 to 3, your take profit needs to have 3 times as times your risk. That means 21 pips. So here as well, it says target is 0.00210. These amount of pips, 21 pips, but it's easier to watch. Just watch it here, 21 pips. So for this trade, 21 pips stop loss, 7 pips risk. And now let's dive into my FX book. So now we are at the position size calculator on FX book. The account currency is US dollar. If you have an account in, for example, the euro or whatever, use your account currency. So for example, my account size is $10,000. My risk, what I want to take with this trade, I want to risk $100 on this trade. Well, what is $100 from 10,000 is 1%. If you don't want to calculate with risk, but just with money, you can just say, okay, I want to risk $100. My stop loss was 7 pips. My trade size is 1. And then if I have my results with a risk ratio of 1%, amount of units, and my sizing, I need to have 1.43 lots. So that means when I go to my broker right now or to my MetaTrader app, when I actually want to execute my trade, I want to buy 1.43 lots to have this trade. And then I can set my stop loss minus 7 pips. I can set my take profit 21 pips, and you have a very nice trade. You can even try this out inside TradingView. So the same trade, you hover over it, you press the right click button, then create limit order. Then you have this nice little window where it already says stop loss 7 pips, take profit 21 pips, exact prices. Then you want to say my stop loss is $100. and I want to make $300, and it already says, okay, you need then this amount of units to buy. And this resonates exactly with the lot size calculator from my FX book that says like 143, if I remember correctly. You can just buy if you want to trade in your broker, but you just know the exact lot size you need to use. So you can do it both via TradingView. I like to use it via my FX book, but that's completely up to you. A final note on a calculation is the risk of leverage. So what we already discussed about when you have a 1 to 100 leverage, that means for your own $1, you get $100 to play with. The same is for when you have $1,000, you can have 100,000 to play with. Leverage is amazing. You can get so much more opportunity compared to when you only have your own money to play with. But this leverage is a double-edged sword. So you need to have really good risk management to use leverage, because the opportunities you get to the upside, there's also is danger to the downside. So for example, you have $1,000 yourself and you get $100,000 to play with because of the leverage. That means when price drops 1% from 100,000 where you played with is 1,000, that is your initial money, and you cannot lose more than your initial money. But when price drops only 1%, broker would just say your money is now gone and we liquidate your whole position, and then you lost your $1,000 just by a drop of 1%. So know that it's a double-edged sword. Yes, you should use it for the opportunities, but focus on your risk management as well. In this video, we went over what a pip is, what a tick is, what a point is, how you can calculate it using the lot sizes, and most importantly, how you can use the lot size calculators. Don't go calculate all that stuff yourself. Use the tools like, for example, from my FX book or from Stinu. You can also use TradingView for this, and you should be fine with your first trade. Welcome to this 8th episode of the Beginner Bootcamp. We're going to talk about brokers and prop firms. First, we're going over what is a broker. Then we're going over what spreads and commissions are. Then I'll give you a whole checklist you can go through while choosing your broker. And after that, we're going to talk about prop firms and best practices to compare prop firms with brokers and what is best for you. First, let's go over what is a broker. A broker is an individual or firm that acts as an intermediary between an investor and a securities exchange, usually buying or selling securities for investor clients. Okay, this is textbook, of course. In normal words, the bridge between you and the market. So the gateway that allows you to trade the market. Now let's talk about spreads and commissions. And this is the way brokers actually make money. First, spreads. The Forex spread is the difference between a Forex broker's sell rate and buy rate when exchanging or trading currencies. Spreads can be narrower or wider depending on the currency involved, the time of day, and economic conditions. So in general, for example, with big news events, you can expect wider spreads. And how does that practically look like? Your normal spreads, for example, Euro US dollar, the sell price is 124.58. Sell, the buy price is 124.60. There's a difference of 2 pips between the buy and the sell. So you have a 2 pip spread. That is normal. Like between 1 to 4-ish spread is kind of usual, kind of normal for your US dollar. And in the second example, you have sell price of 48, buy price of 68. So there's a 20 pip difference. That's a huge spread. So that means like every time you initiate a trade, you are already 20 pips behind on your trade. And for most traders, that's already their whole stop loss. So that doesn't make any sense. So make sure you have a normal spread, no wide spread when choosing your broker. Then commissions. Broker's fees are any commissions or fees that your broker charges you. They're generally charged if you buy or sell instrument or assets. So for example, when you buy Euro US dollar, you pay a certain commission to the broker for allowing you to trade on the market. Those fees are charged as a flat fee or as a percentage of the transaction executed. This can be that you buy Euro US dollar and you need to pay a flat fee, like a few cents for every trade, or you pay a percentage of the total trade you take. Both are good. It can be a hybrid form or both, as long as the commissions are low. So you want low spreads, low commissions, because when you take good trades, you don't want to pay the broker too much because that reduces your profits. And now you know what a broker is, what spreads are, and what commissions are. Let's go over the exact checklist you need to choose your own broker. First, you need to focus on low spreads, low commissions, good leverage. Then you need to check if the broker matches the asset class you want to trade. You want to choose between a regulated broker or unregulated broker. We'll go over the pros and cons. And of course, testing out your new broker. So first is low spreads and commissions and good leverage. Spread, I would say aim for 1 to 2 pip spread max. Could be 3 or 4, but like don't have like the 20 pip spreads from the previous example. High spreads during news is normal, not during low volatility conditions. So when there's nothing going on in the market, you shouldn't have high spreads. Spreads are different though between different asset classes. So for example, crypto usually has a higher spread than Forex. For commissions, low commission. There are zero commission brokers, but keep in mind, a zero commission broker often compensates that lack of revenue via commissions with higher spreads. So don't be tricked. The goal is to find a broker with both very low commission and very low spread. That's the best one. Together with low spreads, low commissions, find a broker who has high leverage. And why high leverage is you have more money to play with. Keep in mind though that recently, time of the recording is 2024, there's lots of regulations on brokers. So for example, in the US, you only can trade with a maximum of 1 to 30. And while having a 1 to 100 or maybe more is of course more favorable because then you have more capital to play with. Next to that, check what kind of position and contract size the broker uses. For example, your 0.01 lot size can make more money than my 0.01 lot size on my broker. And that's to do with the contract size. We're going over how to test that in a second. Next to spreads, commissions, and leverage, you should look at, does the broker match the asset class you want to trade? Most brokers support Forex, metals, and oil. Metals are gold and silver, for example. Not all brokers support index futures and crypto. So if you want to trade Nasdaq futures, for example, please check if your broker actually supports that. Also, check if the asset class you want to trade has good spreads. So for example, you want to trade Bitcoin and you find a broker who has the availability to trade Bitcoin, but their spreads are insanely high and you didn't know that. That's just a waste of your time. And it would be a shame if you deposit and ready to trade to find out for every trade you need to adjust your trade by 20 pips just because of your spread. And you just lose a lot of money just by choosing the wrong broker. Then you have to choose between a regulated broker and an unregulated broker. And let's go over the pros and cons. For regulated brokers, there are huge pros. Why? First of all, you have your safety of your funds. And it means when you deposit your money to a broker who is regulated, if so many rules they need to follow, your funds are safe. And of course, if you're just going to be a degenerate and just gamble all your money away with losing trades, you will lose your money. But if you don't trade, your funds are safe on a regulated broker. Also, there's transparent services because there's a huge regulatory agency who oversees everything they do, every operation. And also, you have favorable dispute resolution. And that means when there's dispute with a broker, so something goes wrong, or you're not agreeing with anything that's against the rules, you have trader protection. So you get protected by a lot as a trader. And that's very nice because if you have a big broker and you are like a small trader, it's nice to be protected. The cons of a regulated broker is you have limited choice in both leverage and deposit method. For leverage, you want to have it as high as possible because that will give you more capital to play with, to play the opportunities you find in the market. And for deposit method, regulated brokers in general only accept like bank transfer and credit cards. While, for example, if you want to stay under the radar, crypto is also a very nice deposit method, which you won't find in a regulated broker. Then unregulated brokers, their pros are, first of all, plenty of bonuses. Like they have a huge war chest. Like being regulated is very expensive. And when you're not regulated, you don't need to pay all that extra money. So you have a huge marketing budget to get new customers into the door. So you get nice deposit bonuses and nice bonuses in general. Also, you have easy accessibility with, for example, no IP restrictions. Regulated brokers can deny some countries they don't like, while unregulated brokers simply don't care. You're just welcome anytime. Also, they have attractive trading conditions, high leverage, low spreads, low commissions, and you can deposit and withdraw in crypto if you want to stay under the radar. Cons, and it's very important compared to the pros of a regulated broker, you have higher risk. Like you have no certainty that your funds are safe. You have no clue what an unregulated broker does outside of their broker activities, with what intentions they are using the broker. So there's no oversight by a third party or buddy. So keep it in mind. And if there's a dispute, if there's something goes wrong, you are on your own, you have no protection and no help from a regulatory agency as a mediator. So keep that in mind. My own recommendation is I would start with a regulated broker, deposit your money, grow your account, get used to taking trades, getting profits, being a profitable trader. And when you grow your account, for example, you start with $1,000, and when you have grown into like 1,500 or 2,000, almost doubled it, put a few hundred to your unregulated broker. So you can enjoy the juicy deposit bonuses, and then you have the best of both. First, start with the regulated broker. Then, as final step of the checklist, you need to actually test out your new broker. And let's go over the most important steps. First, try your broker on a demo account. That means a fake account, and every broker allows that, while you can just test out their services. So for example, my own broker is EPFX. First thing I do is go to the MetaTrader app. This is a screenshot of that on my mobile, log into my demo account, and I'm going to test their spreads and commission. So I go to my asset, for example, Euro US dollar, I press details, and then I see this whole list of what they offer. So I know, for example, the contract size is a standard lot, spread is floating, I know the swap rates. And if this whole list doesn't say much to you, that's totally fine. Just choose the easy method. And that means just buy the 0.01 lot size, 0.1 and 1 lot size, 3 trades, and you see how the spreads are with each lot size. Also very important, check as well how fast the close button works. Delays on that loses you money and your broker loves that. So for example, some unregulated brokers, when you try to close your trade, so for example, you are in $300 profit and you want to close your trade, you expect to just close it at exactly $300. Some brokers have a delay in their closing of the trade. So it can take 5 or 10 seconds before the trade's actually closed. And in that 5 or 10 seconds, the price goes up and down. So perhaps that $300 profit goes into $250 because of that delay. So try to have a broker who doesn't have any delay in your closing, because that can cost you money. You now have tried your broker on a demo account. You've tested spread and commissions and also the delay. Now, for the final steps, you need to test the overall feeling you have with the interface. So do you like the dashboard? Is your overall feeling with the broker good? You need to contact their customer support to check if that's good. Go call them, go chat them, go mail them, see how fast they respond, how willing they are to help you, because that's very important when some issues arise. Also check if you can withdraw your funds with ease. That means that it doesn't take much time for you to actually withdraw your money from the account. Between 1 and 5 business days is completely fine. If it takes weeks, it's of course a very big red flag, so avoid that broker. And most importantly, check reviews on the above online. Check reviews about their customer support. Check reviews about, can you withdraw? Are there any issues with that? Because that can also give a red flag on the broker. So if you put this all together, then you go over the step-by-step summary. First of all, check for low spreads and commission together with high leverage. Check if the broker is matching the asset class you want to trade. Choose if you want to use a regulated or unregulated broker. Try your broker on a demo account. Test their spreads and commission. Test the overall feeling. Contact their support. Check if you can withdraw your funds with ease. And check reviews on the above online. And if every of the 9 steps are a green light, then you definitely should choose that exact broker. Over the years, I tried many brokers, but the one that stood out for me personally when I went through all the checklist was EPFX. And why? It has roll spreads, low latency, so the delay between you executing a trade and closing a trade is very short. Zero commission, good service, good leverage, good spread. So everything I want to trade, so 300 plus instruments. I'll leave a link in the description if you want to check them out. I would highly recommend it. It's a regulated broker to start trading with. Then let's talk about prop firms. Prop firm is a company that provides its traders with access to capital, and in return, the trader shares a percentage of the profits they generate with the company. Prop firms can help skilled individuals propel their trading careers by providing capital training and general support. Okay, this is of course textbook. In normal words, you can trade with other people's money. The cool part is when you prove to the prop firm you are a good trader, they will give you capital to play with. So how a prop firm looks like, when you want to do a challenge at a prop firm and you want to, for example, to go for a $100,000 challenge. That means if you pass the challenge and you prove to the prop firm you're a good trader, they'll give you $100,000 to play with. A challenge like that costs around $500 on most prop firms. What you then need to do is you need to pass 2 phases. In phase 1, you need to get an 8% target. So that means on 100K, you need to have 8,000 in profit. Then you pass phase 1 as like a checkpoint. Then you go to phase 2. Then you need another 5,000 in profit. And then that's all completed. You will get 100,000 to play with. And in general, you get an 80-20 profit split. So that means, for example, if you get 10,000 profit on that account, on that funded account. So that means when you get, for example, on a funded account, 10,000 profits or 10%, you can get 80%. So that's 8K. And the prop firm will take 20%. And that sounds all very nice and very scalable. And yes, it is. But there's one big catch. What most beginner traders forget is you need to be actually able to trade very good to pass prop firm challenges and get those payouts from the prop firms. Most new traders just see, oh, nice, prop firm, very scalable, high leverage. I'm going to start with that. But when you cannot trade, you're not going to pass the challenges and you're just wasting that money on challenges. I would recommend watching episode 38 of the 2024 mentorship. I will leave the link in the description. I will go over everything prop firms and how you get funded and what's the best way to do that. What I would recommend is starting out with a personal account. Let's say you have $500, same example as previous slide. What's the chance of flipping $500 to 100,000? It's not that high, right? Getting a 200x on your money is quite difficult and it takes a very long time. But the thing is, when you're starting out trading, you should start with that. You should put like a few $100s on an account, a few $1,000s on an account and just start trying out. Train yourself, get a system, get a nice trading plan. And when you're confident with your own system and you prove it to yourself, for example, you started with $1,000 and now it's at $3,000. That's a very good result. With a proven system, then go to the prop firms and go to the challenges. And yes, they are very nice and very scalable. For example, with $500, you get a 100k challenge. If you pass that challenge and you only make between 1 and 3% per month, that is an average salary. And when you scale that, so for example, you see based on your past experience that you pass 1 out of 5 challenges, with 20% pass rate. When you buy 5 challenges, it costs you $2,500. You pass 1 account, get a 3% payout, and a 3% payout is just 1 trade, 1 to 3 risk on a 1% risk trade. Your payout will be $3,000, a little less with the profit split, of course, but you get the point. And after that payout, your profit on the batch of 5 challenges is $500. That's amazing. And now you have still that 100,000 funding to play with. And this is infinitely scalable. But again, only when you have a proven trading system and you can actually execute on a consistent basis. To start with personal, when you're developing, when you're growing, when you're becoming really good, then go scale the prop firms and get those payouts. And what you can do with the payouts, just reinvest them back into your personal account to make a nice little money wheel so you can build your personal and prop firm account at the same time. In this video, we first went over what a broker is, went over spreads and commissions, and then we went over the whole checklist on what you should do before choosing your own broker. Make sure you check out EPFX, a very good broker. And after that, we went over prop firms, what prop firms are, trading with other people's money, and how you can use that in comparison with your personal account to scale both. To start with personal, then scale the prop firms, reinvest the prop firm payouts back into your personal account to create a nice money wheel and scale your bank account as a professional trader. All right, welcome to this 9th episode of the Beginner Bootcamp. I'm going to talk about how to develop your own trader identity. Before we dive into the video, let's do a small recap. By now, you should know how to read candlesticks and their respective patterns. You should know what time frames are with the Rule of 3 framework. You should know what to trade on the Forex market and indices. You should know how TradingView works, what futures are and how to trade them, what leverage is, with points, pips, ticks, together with lot size calculation, and of course what a broker is and how to choose yours with the broker checklist, and what a prop firm is and what the advantages are compared to a broker and how you should use them both. In this video, we're first going over the trader recipe, then we're going over the trade languages, about how to choose your own trade language, then we go over the different trader types, and about next steps. First, let's talk about the trader recipe. So imagine you're cooking something nice, you're making pancakes for your loved ones, and in those pancakes, you need to have some nice ingredients. And the same we're going to do to determine your trader type. And the first thing you need to determine is in how far you are a fundamental trader and how far you are a technical trader. I think you should be a bit of both. So a fundamental trader focuses on the macroeconomic conditions, so mainly focus on news, and a technical trader mainly focuses on technicals. You should be a bit of both. So put a little bit of both in a recipe and you should be good. Some traders are more towards fundamental and some are more towards technical, but you can be both. Then you need to choose a trading language. And the most common trading languages are support and resistance, supply and demand, ICT. We're going to talk about it later. And also, you need to determine your time frame. Are you a scalper? Are you a day trader? Are you a swing trader? Or are you a position trader? And when you put those 4 together in your trader recipe, you will get a nice trader type. And based on that trader type, you can develop and grow into that type of trader. It's all about intentional improvement. So when you know what trader type you are, you can exactly make a roadmap for yourself, what you need to do to become that type of trader. Let's talk about the trade languages. A trade language, just like a regular one, is a way to communicate. And as a trader, it's a way to communicate with price action and the market in general. Very important, there is no good or bad, right or wrong in this decision to choose a certain language, as all of them can make you money while executed consistently. Don't believe people who say ICT is the holy grail. None is the holy grail. Everything works as long as you execute consistently. And the 3 most used trading languages are support and resistance, supply and demand, and ICT and smart money concepts. One of the 3 languages you can speak to the market is support and resistance. And you see here in this image how that looks like. Technical analysis use support and resistance to identify price points on a chart where the probabilities favor a past or reversal of a prevailing trend. Support occurs when a downtrend is expected to pass due to a concentration of demand. Resistance occurs when an uptrend is expected to pass temporarily due to a concentration of supply. So you see here, make higher highs, higher lows, higher highs, higher lows. And at some point, support breaks and then we're going lower. Market psychology plays a major role as trader investors remember the past and react to changing conditions to anticipate future market movement. So when we come back to a resistance area, people expect price to just keep that resistance and go lower. when price goes to a support area, people think, okay, the support area, you can go higher from that. Support resist areas can be identified on charts using trend lines and moving averages. The second language you can speak is supply and demand. And supply and demand zones are areas on a price chart where the price of an asset tends to stall or reverse. They represent areas where there is a significant concentration of buying or selling pressure, which can impact the direction of price movements. This is a depiction of how that looks like. You have an accumulation on a demand zone, and you're trending upwards. They're coming in a supply zone. This looks like support or resistance in some way. Then you're in a supply zone or resistance area, distribution lower. Second stage of accumulation, you're going higher again. And here as well. Higher highs, higher lows, higher highs, support, resistance. So again, every language has some overlapping parts with each other, just like a regular language, but it should suit your personality and trading style. A supply zone, there's an excess of sellers causing the price to drop right here. This occurs when supply exceeds demand and traders are willing to sell at a lower price. So there are more sellers than buyers in a certain area, so we go lower. Demand zone is vice versa. There's an excess of buyers causing the price to rise. This occurs when demand exceeds supply and traders are willing to buy at a higher price. That means here are more buyers than sellers, the price goes up. Here are more sellers than buyers, so we go lower. And here again are more buyers than sellers, so we go up again. The third language you can speak is ICT or Smart Money Concepts. Smart Money Concepts is invented by Richard Wyckoff over 100 years ago, and ICT continues with the S&T concept and gave it its own flavor. They both deal with liquidity, inducement, imbalances, manipulation, premium discount. ICT talks about the algorithm, IBDA, that delivers price, and the big money and banks are using that. Learning ICT basically is learning to trade like the banks. In Wyckoff's day, the technology wasn't available for an algorithm to exist. So Wyckoff started with the smart money concept, and then ICT gave its own flavor, like a little layer on top of that with his ICT concepts. All the ICT concept is free to find on the Inner Circle Trader YouTube channel. And the ICT language is the language I'm speaking myself. So the content you will find created by me is mainly ICT concepts. Here's a depiction of how an ICT setup looks like. In this video, I'm not going into detail into this, but in other content in this channel, you will find many ICT concepts and setups. Then let's talk about choosing your language. And let's go over some ground rules. First of all, there's no right or wrong with any of the languages. Support and resistance, supply and demand, ICT. There are many more, but the three biggest ones we just discussed. Don't believe people who tell you theirs is the almighty truth. A very important ground rule. The important part when you're starting out is to choose your language and then stick to it for at least a few months. And this is to avoid strategy hopping. What most people do, they learn a new language. So for example, support and resistance, and they try it for 2 weeks, and then they take 2 or 3 losses in a row, which is very normal for a trader. And then they're like, no, this doesn't work. I'm going to find something new. And then they find supply and demand or ICT. And then they do the same. They learn it for a few weeks, get a few losses in a row, and they're like, no, this doesn't work. And they go into YouTube, find the next 90% win rate setup, and that strategy hopping goes on and on and on. And it's just a cycle downwards, and you don't learn anything. Also, it should resonate with your personality and preference. Just check them out, and you will know when it suits you. When you think this specific language is the way you could look at the market and it makes sense to you, then you have found your language. Feel free to try them out yourself using free tutorials on YouTube. Don't buy few $1,000 courses, guys. It's not worth it. Feel free to try them out yourself using free tutorials on YouTube. Don't go buy courses who cost you $1,000. Everything, all the basics for all the languages are free to find on YouTube. And the next and final part of the beginner bootcamp, there will be a full beginner guide to ICT, and that's the language that I'm speaking. So where we didn't go into detail into this, the next part you will see a huge explanation on everything ICT. So when you've found your trading language, it's time to look at what type of trader you want to be at the time frames. And you can be a scalper, you can be a day trader, you can be a swing trader, or you can be a position trader. And let's go over all 4 of them to see which one most resonates with you. A scalper is a trading style that focuses on making numerous small trades within short time frames, aiming to profit from small price fluctuations. Scalpers typically hold positions for seconds to minutes and target small gains on each trade, and this style requires a quick decision making, fast execution, and the ability to closely monitor the market. The scalper is the most fast-paced, intense way of trading. Day trading involves opening and closing trades within the same day. Day traders aim to profit from intraday price movements and typically do not hold positions overnight. Most of the time, just a few hours. They use technical analysis, chart patterns, and short-term indicators to identify trading opportunities. And day trading requires a disciplined approach, the ability to manage emotions, and active monitoring of the market throughout the trading day. So where scalping is in and out in a few seconds or maybe a few minutes, day trading is a little longer, 1 hour to like few hours, but intraday, so no overnight positions. So at the end of the trading day, you are out of your position. Then you have swing traders. Swing trading involves holding positions over a few days to several weeks, aiming to capture a short to medium term price swing within an established trend. So you see price going lower, lower, lower. Then you see price reversing to the upside, and then you try to catch that whole move to the upside for a few weeks as a swing trader. Swing traders analyze technical indicators, chart patterns, and market trends to identify entry and exit points. So for example, you have that low reversal, you go to the upside, and you have an old high as your target as an exit point. This style requires patience, the ability to analyze the market movements, and the tolerance of holding trades overnight. As a swing trader, you're going to hold your trade for a long time. And that means in that long time, you will see your trade go up, go down, go up, go down. But you need to be able to hold. So you need to have very big patience for that. And the fourth one is position trading. It's a long-term trading style where traders hold positions over a week, months, or even years. Position traders focus on major trends and aim to capture significant price movements. They rely on fundamental analysis, so macroeconomic factors and long-term trends to make trading decisions. Position trader requires a long-term perspective, strong risk management, and ability to withstand market fluctuations. So position traders are mainly the hedge funds, the big money, who are holding trades for years. I know that the people who are watching this video are not going to be a position trader. You want to be a scalper, day trader, or swing trader. And I found this on an Instagram, and I think it's very, very nice to incorporate in this video. What type of trader are you? And the scalper, day trader, and the swing trader. With scalper, you don't have any free time because you're on the market the whole time. You're in lots of stress. Your risk is high. Your reward is high because you are in and out within a few seconds, within a few minutes. So you're like that server dude who catches every wave and just goes. As a day trader, you're just in a boat rowing. You have some free time during the day. Your stress is okay. Your risk is okay. Your reward is also okay. Not too big, not too small, just very consistent. And a swing trader has lots of free time because they don't need to look at the market the whole time. They are holding their positions for at least a few days. They have no stress because they're like, okay, yeah, I'm now taking a trade and maybe later this week or next week, I have my take profit or my stop loss. I lose or win. The risk is low, reward is low, but because of that, you are more zen, more chill. And it should resonate with your trader type. Because if you, for example, work a full-time job with lots of responsibilities and lots of calls, you cannot look at the market. Then, of course, you cannot become a scalper because you need to be on the market the whole time. Same if you have a busy job. Day trader can also be quite challenging. Of course, you can take a few days from your working day to focus on the market. But most starter traders should just start with swing trading. Just take a trade, hold it for 1 or 2 days, and see if you are right or wrong to train yourself. There's no right or wrong. It should resonate with your personality, with your current situation, and that's totally up to you. You might remember from episode 2 of the bootcamp about timeframes, the trader types, and combined with the time frame. So a scalper is on a minutes, an hourly time frame. They check the price like every 1 to 15 minutes. They check it a lot, no free time, lots of stress. Day traders are on the hourly and 4 hour. They check the price every like 60 minutes or so. Swing traders are trading the hourly and daily, and they check charts around every 4 hours. And position traders are on the daily and weekly time frame, and they check their position like daily or sometimes in a few days. So now you know the whole trader recipe. So you need to be a little bit of a fundamental trader, focusing on news and macroeconomic conditions. You need to be a technical trader, a little bit of technicals. In your technicals, you need to find a trading language. You can do support and resistance, supply and demand, ICT. Just choose the one that resonates the most with you. And then you need to choose your time frame. Are you a scalper with no free time, lots of stress, but high risk and reward? Are you a day trader? Are you a swing trader? Are you a position trader? And choose that for yourself. And then it's the question, what now? You've watched all the 9 parts. You started with candlesticks, then you've seen time frames, then you knew what to trade, what pairs. You went through the TradingView tutorial. Then you knew what market structure was, how to trade indices. You know everything about leverage, about brokers and prop firms, and now you even have your own trading identity. What now is watch the final part of the beginner bootcamp to introduce yourself to the first language, ICT. Then go back to your notes and check if you are familiar with all the concepts from the previous parts of the bootcamp. If not, just go watch it again, take notes, and most importantly, implement the knowledge. Don't use it as a Netflix, focus on actually implementing the knowledge. And then choose your language and your trade type. So for example, an ICT language, day trader, time frame type, and start developing your trading career step by step. If you like this beginner bootcamp where you learn every single puzzle piece that you need to become a trader, then you're definitely going to like the 2024 mentorship. Inside the school group under Classroom, you can find the free 2024 mentorship right here. And in this 2024 mentorship, there are 40 plus videos that help you further develop your understanding about trading. And next to the 40 videos, there are community posts about COT reports, psychology, there are bonus episodes, there are entry models for you, so everything you need to become a better trader. When you have completed the beginner bootcamp and also the 2024 mentorship, you are at an amazing level to start leveling up like crazy. Then the inner circle mentorship comes in. This will be a private mentorship where me and my team are going to make you a beast of a trader. We're going to focus on how you level up in life, going over your psychology, discipline, your consistency. We're going over your trading plan. We're going over journaling, trade management, over getting funded, getting payouts, and everything you need to become a professional and profitable trader. You can enroll for the mentorship in the link in the description. Let's get back to the video. In this video, we went over the trading recipe and everything you need to know to develop your own trading identity.
And now you come to the end of the beginner bootcamp. And I want to congratulate you. Where everybody else is doom scrolling on their TikTok and their Instagram, you actually decide to take the step to take trading seriously and studying for more than 2.5 hours. Keep doing what you're doing. I think you're going to have amazing value out of the free Market Master School community. So please check it out in the link below. If you like this kind of videos, like and subscribe, share it with all your trading friends, and I'll see you in the next one.